Namaskar friends, welcome to the channel JAIIB and CAIIB Made Simple. So in this video we are going to completely revise our IIBF AML KYC syllabus as per the syllabus which has been prescribed by the IIBF, right? So if you have examination of AML KYC in the upcoming few days, so just go through this 4-hour lecture. I have covered the maximum topic from where question have appeared. So make sure that you go through each and every points minutely, and if it is possible then try to repeat it, and after going through the entire video you will feel confident in solving those MCQs. And if you want the content in a structured manner, unit wise theory, unit wise MCQs, this kind of capsule content, so you can WhatsApp me on the number shown on the screen to get complete study material for the upcoming AML KYC. Not only we provide the content, we also provide you the memory based question so that you can gauge what level of question is being asked in the. First, we will quickly understand the essential of KYC AML in simple way. First of all, customer identification. So this is the foundation of compliance with the anti-money laundering and counter-terrorism financing rule. Bank must know exactly who their customer is. Then come beneficial ownership. Not just the name on paper, but the real person who ultimately control or own the business. Then comes risk categorization. Means every customer is classified as low, medium or high risk so that the right level of due diligence can be applied. With a risk-based approach, bank use more resources on high-risk customer and less on low-risk one, making the process efficient. If we talk about the verification, verification require valid document. Only officially recognized ID proof are accepted. The fundamental of AML KYC are simple: focus on genuine customer transaction, proper identification, and thorough due diligence. If we talk about global and domestic regulation, yes, both global and domestic regulation highlight the importance of a strong KYC and AML practice. Regulators also issue a specific standard that bank must follow, and meeting this standard is key for controlling the risk. Now finally, definition of customer under KYC is broad. It includes any person, any entity that does financial dealing with the bank. So in short, KYC and AML are about knowing the customer, verifying documents, assessing risk, and strictly following regulation to keep the financial system safe. Now friends, let's understand the definition of customer under KYC. The scope is much broader than just a normal bank client. As per RBI, the customer is any person who is part of the financial transaction or activity with a reporting entity like a bank or a financial institution. So customer is any person who is a part of the financial transaction or activity with a bank or reporting entity. It is inclusive in nature. So this is inclusive in nature. KYC customer is inclusive in nature. This means apart from direct account holder, even the connected parties are also covered. That is the meaning of inclusive in nature, because apart from direct account holder, even the connected parties are also covered under the definition of KYC. Now this include owner of the entity doing the transaction, the beneficiary who is intermediary for their dealing. So that's why it is called inclusive in nature. It includes the owner of the entity, it includes the beneficiary, right? So apart from the direct account holder. Now as per the PML Act, that is called Money Laundering Act, right? Prevention of Money Laundering Act. The word person also had a wide coverage. Word person includes individual, HUF, companies and partnership firm, and even artificially judicial person, right? So these are called person. Person includes all of this. So in simple term, under KYC and PMLA, the definition of customer and person is very wide, covering not only direct client but also all connected parties and entities. Now friends, let's talk about the beneficial ownership and the related concept. First of all, it includes not just company but also their agencies, office, branches that are owned or controlled by them, right? The idea of beneficial owner is central to the anti-money laundering and the countering financing of terrorism rules. Remember, the idea of beneficial owner is central to the anti-money laundering and countering the financing of terrorism rule. It means identifying the real person behind a transaction, not just the name on the paper. In banking, most transactions happen with the judicial person like companies and firm, not always with individual. That's why knowing who truly own or control them is very important. Now, identifying the beneficial owner ensure transparency and prevent misuse of entity as transaction vehicle. Regulators have clear criteria, right, for determining the beneficial ownership, right? And prevent basically for different types of entity, regulators have given clear criteria for determining the beneficial ownership. But things get tricky in complex structure. where ownership is layered, indirect, or spread across multiple entities. In such cases, extra care is required to trace the ultimate control. So in short, we can say beneficial ownership is about finding the real face behind the financial dealing to ensure transparency and to ensure the compliance. Now friends, let's understand the rule 9 subsection 3 of the PML rule, which talk about the beneficial ownership. This rule gave the regulatory method to identify who is the real beneficiary owner across all customer category. The criteria are threefold. First come ownership. Ownership means if someone hold equity, shareholding or capital above a prescribed threshold, that is called ownership. Second point is benefit entitlement. So if a person enjoy return or if a person enjoy benefit from the entity beyond a set limit, that is called benefit entitlement. Control. If someone has authority over management, policy, key decision of the entity, that is called control. What is important is that identification can be based on any one of these criteria: ownership, benefit or control. This gives flexibility and ensure that all possible structure of ownership and influence are covered. So in short, we can say rule number 9 subsection 3 makes sure that bank and institution can always trace the true person behind an entity, whether through ownership, whether through benefit or through control. Now friends, let's talk about the beneficial ownership. First the criteria apply. Let's look at the examination norms for beneficial ownership. First, the criteria apply regardless of how ownership or control is structured. So remember, applicability of the beneficial ownership is like this. The criteria will apply regardless of how ownership or control is structured. Bank must carefully examine the ownership chain to trace it back to the natural person who ultimately control or benefit. But the scrutiny has a limit. Bank need to go only till they reach reasonable satisfaction, not endlessly. In complex cases, ownership may be layered or difficult to unravel. Regulators accept that sometimes it is very hard to identify a natural person. That's why there is a rule that is called fallback rule. If no natural person can be identified, then the senior managing officer of the entity is treated as the beneficial owner. That is called fallback rule. That means if no natural person can be identified, then the senior managing officer of the entity, he is called the beneficial owner, right? Now friends, let's talk about for company specifically, the ownership test say anyone holding a controlling ownership interest qualifies as the beneficial owner. That is the rule for company. Anyone holding beneficial interest, right? Anyone holding beneficial controlling ownership interest qualifies as the beneficial owner to the context of company. So in short, the goal is always to find the real individual behind the entity. But if that is not possible, the senior most official is considered the beneficial owner. Now, beneficial owner entity-wise criteria. So let's understand the entity-wise criteria for identifying the beneficial owner under the rule number 9 of the PMLR. First of all, for company, if a natural person hold more than 25% shareholding, capital or profit, they qualifies as the beneficial owner. Friends, if you are looking for study material for AML KYC in the form of PDF, in the form of videos, in the form of previous year question, then you can WhatsApp me on the number shown on the screen. I will provide you the PDF, I will provide you the content. We have an app named JAIIB and CAIIB Made Simple on which the entire content is available. So you can get the content. Many aspirants have cracked the examination using the content. You can also. So let's come back to our discussion. So what I was telling you, that if a natural person hold more than 25% shareholding, capital or profit, they qualifies as the beneficial owner. Or suppose if someone control the company through management right, voting power or agreement, they also qualify. What about partnership firm? Any person holding 15% or more of capital or profit share, they are treated as the beneficial owner. What about unincorporated association or body of individual? Same rule. Person with 15% or more entitlement in property, capital or profit is the beneficial owner. What about the trust? See, trust, the rule is that beneficial owner include the author, settler of the trust, the trustee, beneficiary with defined interest of 15% or more, and any natural person exercising ultimate control directly or indirectly. What about listed company and their subsidiary? So they are given an exemption. Suppose an entity is a listed company on a recognized stock exchange or its subsidiary, then bank do not need to identify the beneficial owner. So that is the rule for listed company and their subsidiary. How they are given exemption? If one entity is a listed company on a recognized stock exchange or its subsidiary, the bank do not need to identify beneficial owner. So in simple word, rule number 9 clearly define different threshold for different entities, right? But the main aim is always to find out the real person behind ownership or control. Now friends, let's talk about the key norms of the KYC and customer identification. First, for non-account based transaction, have a walk-in customer must provide identification if they do transaction of 50,000 or more, whether in one go or linked together. That is for non-account based transaction. Walk-in customer must provide identification, right? And if there is a suspicion of structuring, meaning a person trying to break a big transaction into a smaller one to avoid reporting, then KYC check become mandatory. Third point is that at the time of account opening or during periodic review, bank must collect all essential KYC information. In case of non-usual or complex transaction, bank need to apply additional due diligence. Now, any non-mandatory data can be collected after the customer relationship is established and only with the customer consent. Finally, for identity proof, rule number 9 of PML's rule clearly lists the acceptable document that bank can use for verification. So in short, we can say KYC norm ensure that all unusual or suspicious transactions are properly identified and verified. Now friends, let's talk about the customer identification. Let's understand the key aspect of customer identification. The main focus is simple. Identifying individual correctly is central to the compliance. For this, bank rely on the officially valid document, or we call it OVD, which are defined under Rule 2, subsection D. So these documents serve as a proof of both identity as well as the address. There is one exception. The PAN card, it is valid only for identity, but it does not have address detail. Right? PAN card is valid for identity only. It does not have address detail. The commonly accepted OVD, officially valid documents, are passport, which is valid for both identity as well as address. Driving license, valid for both. PAN card, valid for identity only. Voter ID card, valid for both. Narega job card is signed by the state government officer. They are valid for both identity as well as the address. So in short, we can say KYC relies on a specific list of OVD, and bank must use this document to confirm who is the customer and where they live. Now there are some additional KYC documents. What are they? So along with the standard OVD, there are some additional KYC documents that bank can accept. First is the letter from UIDAI or NPR. It is valid for all purposes since it contains the customer name, address and Aadhaar number. For low risk customer, simplified KYC is allowed. So what are the options? First option is the identity proof. Identity proof can be issued by ID card issued by the central or state government department, regulatory or statutory authority, public sector undertaking, a scheduled commercial bank, public financial institution, or even letter from gazetted officer with attested photo. That is called identity proof. Now then after we have the proof of address option, like utility bill like electricity, telephone, postpaid mobile, pipe gas or water, but they should not be older than 2 months. Tax receipt or bank statement is another proof of address, or PPO, pension payment order, right? So in short, simplified KYC make it easier for low risk customer to open account while still ensuring proper identification and address verification. If we talk about the simplified KYC, right? So additional option is there, and an employer allotment letter can be used as an address proof if it is issued for accommodation. Then foreign government documents are also accepted, including letter from foreign embassy or mission in India. If we talk about the change of the name, so the amended PML rule provide clarity for customer who have legally changed their name. Importantly, OVD in the old name continue to remain valid, so customer don't face any hardship. So in short, we can say KYC rule are flexible for low risk customer and the name changes, ensuring verification without unnecessary difficulty. What is the rule for KYC name change submission? Let's have a look. Now friends, let's look at the KYC process for name changes and Aadhaar based eKYC. Suppose name change submission is there. Individual need to submit an officially valid document along with either a marriage certificate issued by the state government or a gazetted notification reflecting the name change. Then eKYC with Aadhaar verification. UIDAI eKYC service is recognized as a valid KYC process under the PML rule number 9. The information and photo obtained via Aadhaar eKYC is treated as an OVD. The data shared electronically with the bank or intermediary include name, age, gender and photograph. Importantly, this information is released only with the customer biometric consent. So in short, name changes and Aadhaar eKYC make the KYC process flexible, quick and secure. Now we have some alternative Aadhaar verification option. So what are the options? So mode number 1 we have is verification of identity and address through the UIDAI authentication service. Mode number 2 is the submission of a copy of e-Aadhaar previously downloaded by the customer. Now if you look at the basic KYC documents for individual, so what is mandatory Certified copy of an OVD with identity and address is mandatory. A recent passport size photograph, right? And what is optional? Any additional paper showing business activity or financial status as per the bank discretion, that is optional. If you look at the KYC policy guideline, bank must include OVD and photograph as compulsory element in their KYC policy. Any extra document can be requested at the bank discretion. So in short, KYC ensures that identity and the address are verified reliably, while bank can also seek additional. So what I told you, that photograph is needed for all individual, including Pardarshini women. It also applies to person linked with the judicial personal account. If you look at the KYC for a special account type, then we have the joint account. Each applicant must submit KYC document. Relaxation. For close relative, that address proof process may be simplified. What about the minor account? KYC is done in the guardian name. Bank must obtain the guardian photo and preferably the minor's birth certificate. When the minor attain majority, a full KYC including the face photograph is compulsory. So in short, KYC ensure proper identification through photograph and financial proof. Now friends, let's look at the KYC judicial entity, which is called non-individual. So let's discuss KYC for judicial entity, which are basically non-individual customer like company, firm or association. So entity documentation. So bank must collect a specific document as prescribed under the PML rule and RBI guideline, depending on the types of entity. So if you look at the beneficiary owner and attorney holder, so apart from the entity document, KYC must also cover the beneficial owner and authorized signatory or attorney holder similar to individual customer. If you look at the streamlined KYC procedure, there is something called single OVD requirement. So only one officially valid document is needed for identity and address. If suppose you choose PAN as an OVD, and PAN does not have the address, so an additional OVD with address must be collected. For current or permanent address, one valid OVD is enough. And if the current or local address differ, bank can accept a self-declaration from the customer. So in short, KYC for judicial entity focus on entity document, beneficial owner and streamlined address verification. Now, so I hope this is clear. Now address change rule, yes, very very important. If there is a local or current address, as you can see, we are talking about the address change rule. So customer providing a correspondent address must have it positively verified. Verification can be done through bank communication delivery, field visit or other reliable method. Bank need to be careful in choosing the verification method. If you look at the courier service standard, only reliable courier service should be used. Delivery must be ensured after proper verification to avoid any security issue. If you talk about the address change rule, so customer must inform bank within 2 weeks of shifting to a new address. Yes, within 2 weeks of shifting to a new address, customer must inform the bank. Bank should communicate this rule at onboarding, usually in account opening form, or we call it AOF. If the address on OVD become invalid, the customer must submit fresh proof within 6 months. A special case is that relative without OVD. Family member without an OVD can provide alternative identity proof acceptable under KYC norms. Now friends, let's discuss the address declaration and verification under KYC. I told you what are the rules under address change. Customer must inform the bank within 2 weeks of shifting. Bank should inform this rule at onboarding in the account opening form. Now KYC relaxation and a special provision. So using officially valid document of close relative, this is allowed if supported by a declaration confirming the relationship and the address association. Right. And new account and account transfer. Suppose the customer is already KYC compliant, no need to resubmit the document. And for address change during transfer, self-declaration by customer is enough. Document deferral. Suppose if the low risk customer is there, if he is unable to provide OVD immediately, but reason are genuine, so account can still be open, right? So these are the very very important point. Now let's talk about the document submission rules. Yes, what are the rules? So basically KYC document must be provided within 6 months of starting the customer relationship. This 6 months is very very important. So all kind of KYC document must be provided within 6 months of starting the customer relationship. Second point is a deferral for low risk customer. Bank can start the relationship even if the OVD are not immediately available, but they must apply the extra check to verify the identity and the authenticity. Now use of third party for document collection. Third party can be used only if they are regulated, supervised or monitored under applicable framework. They must have proper due diligence. They must record keeping procedure for KYC check. The jurisdiction of the third party should meet acceptable regulatory standards. These are the key points. Now friends, let's talk about the third party KYC support and condition. So key condition are immediate data access. which means bank must get all necessary information from the third party without the delay. Then if you look at the document availability, so copies of ID data, copies of record should be provided quickly upon request. Then if we talk about the ultimate accountability, even if a third party help, the bank remain fully responsible for KYC compliance. Now, what are the customer risk categorization? The main purpose is to allocate resources based on risk level. That is the main purpose, to allocate resources based on the risk level. Bank have flexibility to design their own risk category. If you look at the regulatory minimum, at least 3 categories are required: high risk, medium risk, and the low risk. These are the 3 categories. And bank can introduce a more refined group for better alignment with the customer risk. Now, customer risk categorization, very, very important. So friends, that number of category. So minimum required are low, medium, and high. Some bank use up to 5 level for final risk differentiation. So now, risk-based differentiator. So high risk customer, they have a stricter AML KYC measure. Low risk customer, they have simplified monitoring. Now, differentiated measure may include customer identification and due diligence, KYC and profile updation cycle, and finally, intensity of transaction monitoring. What are the risk determinant? Account type, account vintage, presence in negative or caution list, adverse media report. And then we have customer background and transaction behavior. So these are the risk determinant. If you look at the risk rating model, first one is the goal based, to achieve the objective and the consistent classification. Right, goal is to achieve the objective and consistent classification. What is the method used? So develop scoring model using weighted parameter. Consideration includes, what are the things under consideration, like customer base size, then diversity of segment, business profile, geographical spread, cross border dealing. These are called consideration. If you look at the risk rating, so friends, data driven input, which means risk determinant come from information captured on the customer profile. Then we have the automation in CBS. So the core banking system can automatically generate a risk rating once the customer profile is completed. Next point is a score-based approach. So risk is calculated using an aggregate score assigned to multiple parameters. So what is this score-based approach? A score-based approach, risk is calculated using an aggregate score assigned to multiple parameters. Now if you look at the determining risk category, we have the multi-factor model, in which classification is based on several parameters, not just one, like the business type or the income. Then we have the dominant factor influence. Certain high risk activity can automatically push a customer to a higher risk category. For example, diamond traders are often classified as high risk due to the nature of their trade. What about the overriding factor? Bank can use a special rule when a special factor justify changing the risk category from the model outcome. So in short, risk rating are data driven, score based, flexible, ensuring accurate classification of customer according to the potential risk. Risk rating adjustment. So overriding factor, risk model allow adjustment if a specific parameter is strongly influence the risk. Then we have the manual override. So bank can apply a controlled manual override to fine tune risk category assignment. Then we have some examples, like RBI provide example to guide bank in differentiating customer risk category. If you look at the customer risk categorization, we have the low risk customer, like petty traders like hawkers, plumbers, cobblers, retired personnel or pensioners, salaried individuals, housewife from low or middle income threshold. Then we have the UN recognized NPO, that is called non-profit organization. So what about the medium risk? Now what are the things under CKYCR, that is called Central KYC Registry. So it is a standard template introduced via CKYCR to standardize the customer information. Minimum requirement. So data captured in the template form the basic customer profile. What are the additional input? So bank may collect extra detail depending on the customer type and the risk level. So in short, we can say bank must profile customer according to the risk using CKYCR template while adding extra detail for high risk taker. What about the customer privacy and confidentiality? So there is something called confidential duty. So bank must strictly protect customer data under the privacy norm. There is something called need-based collection. So only information required for identity verification or business decision should be collected. Right. Then we have the consent for extra data. If additional detail are needed, bank must open separate written statement explaining the purpose. So what are the restrictions on use? So that customer information cannot be disclosed to a third party, or it cannot be misused for commercial gain. What is the product risk categorization? Different financial product and service carry different level of risk, different level of money laundering risk or terror financing risk. So carrying basically different categorizing product by risk help in better monitoring and efficient allocation of the resource. So in short, bank must protect customer data carefully and categorize product to manage AML CFT risk effectively. So friends, let's talk about the product risk categorization and what factor influence it under AML KYC. So factor influencing product risk or ML or FT. So the rule is that flexibility is the one factor that influences the product risk. So more freedom in deposit or withdrawal increases misuse potential. Cash transaction, higher cash involvement means higher risk. Source of fund, restriction or lack thereof affect vulnerability. Customer anonymity, greater anonymity increase money laundering or treasure financing exposure. Nature of use, domestic versus cross-border usage changes the risk level. User segment, risk depends on who can use the product. If you look at the product risk parameter, so we have the transaction value limits, which says higher limit means higher exposure. Then we have the tenor flexibility, which means longer or variable tenor may raise risk. Ease of identification, simple verification lower the risk. Number of parties, so that multiple layer or parties increases the complexities. We have the product design and complexity. Bundled or complex product carry the higher risk. So for example, you can see higher risk is complex, high value, cross-border product like cash credit limit, project loan, diamond dollar account. What about the medium risk? They are modern transaction size, right? More moderate transaction size and product like non-resident deposit, credit card and demand loan. What about the low risk? So low risk are simple, low value product, term loan, secured against asset, consumer loan, and then we have the fixed deposit. Now, risk of the new technology. Yes, obviously there is a risk of new technology. Feature like anonymity, remote access, STP, right? Because of this feature, what is STP? Straight through processing, make them more vulnerable. Example is credit card, debit card, prepaid card. They carry higher risk due to cross-border use and layering potential. So in short, bank categorize product by complexity, value and usage pattern to manage money laundering and terror financing risk. Now, friends, let's discuss risk associated with the card product. Provide global access to the fund. It can be misused by third party, increasing money laundering and terror financing risk. What about net banking? It enables instant fund transfer. Minimal or no face-to-face interaction with the bank make them more vulnerable. What about the delivery channel? So bank use multiple channel which expand avenue for ML and TF risk. Then we have customer sourcing method like direct sale agents, partner agencies such as microfinance institutions, right, AD2 dealers and cooperative bank, business correspondent. So in short, digital access and multiple delivery channel increase ML and TF risk. Now let's talk about the modes of service delivery or banking channel. That ATM, partner agency, business correspondent, point of sale, net banking, phone banking, mobile banking apps. So these are the different modes of service delivery, right? So these are the modes. What are the factors impacting MLTF in channel? So nature of the channel. Is it direct or is it indirect access? Extent of the customer interaction. That means face-to-face interaction or remote interaction. Level of anonymity granted. Transaction speed and scalability. And finally, we have the cross-border capability. So these are the factors which impact ML and TF risk in the channel. What about the delivery risk channel? Delivery channel risk category. So channels are categorized as low, medium, or high risk depending on control over customer identification, volume and value of the permitted transaction, potential for anonymity and misuse. So in short, bank assess delivery channel carefully, balancing convenience with AML CFT risk management. Now let's discuss the delivery channel risk factor. So as you can see, ease of customer verification by staff, then direct versus indirect interaction with the customer, involvement of intermediary in transaction, adequacy of document and information available. These are the point. So some example is given like branch banking, low risk as direct staff customer contact is there. ATM, medium risk. Why? Because of limited verification, cash based. And phone banking, higher risk because of remote access, highly anonymity. right? Now then we have the CDD. CDD is broader than just identity proof. It includes legitimacy of the customer activity. What are the core components of CDD? You should collect and verify customer information. You should establish the true identity with positive check. And finally, understand the customer activities and ensure that they align with the declared purpose. What are the verification method? Field visit is one technique to address or business. Then reference check with neighbor, supplier, associate is another technique. Interaction with the known acquaintance. Review of the media or public domain information. The objective is to confirm the real identity and genuineness of the customer activities. So in short, CDD ensure that bank know their customer well and delivery channel are assessed to manage risk effectively. What is basic and normal due diligence? That is called BDD. See, BDD means collection of the minimum KYC document and the basic customer detail. So what are the information collected? Customer identifier like name, address, date of birth, then occupancy, occupation or activity, expected account turnover, anticipated average balance and income, types of service likely to be used. If you look at the applicability, normally applied to the medium risk customer. What is enhanced due diligence? It means more detailed information to understand a specific transaction pattern. That is called enhanced due diligence. Means you need more detailed information to understand the specific transaction pattern. What is the importance of it? It provides clarity on the customer behavior in the context of AML. It helps detect unusual transaction against expected activity. For example, broad tag like self-employed is insufficient. A specific detail like the chartered accountant shows expected financial dealing. So in short, BDD is for a standard check, while EDD dig deeper for higher clarity on customer behavior. So BDD is the normal due diligence, EDD is the enhanced due diligence, BDD is the normal check, EDD is the enhanced check, right? It shows the expected financial dealing. Now if we talk about the customer profile, so customer profiling, it includes customer with limited or regular income from clearly known source. What are the financial inclusion KYC relaxation? So objective is to ensure people without OVD are not excluded from the financial system. What is the approach which is used? So relax norm for certain category to enable account opening. Enhanced due diligence when it is required. So it is when it is applied when normal due diligence is insufficient, especially for high risk customer. What is the nature of measures? So you can see more stringent check tailored to the perceived level of risk. It may include additional document, verification step or monitoring. Product specific EDD. Product specific EDD is mandatory for high risk product. Like suppose remittance for import. This is a high risk product, and that in such case, product specific EDD. EDD means exchange due diligence is required. Then the second category we have is customer group specific EDD. This apply to risk prone group like non-resident like NRI, NRO. So in short we can say bank relax norm for low income customer but apply EDD for high risk customer or product to manage AML and CFT efficiently. Now enhanced due diligence key measures. That document verifications. You should collect the financial record, business license, registration, then organization information. You should verify the company structure, branches, office, plant, factory, and check major customer and supplier. Then business activity detail. So understand the nature of activity, whether it is manufacturing, trading, services. Then inquiries and research. Make independent check with the customer and supplier and conduct media research on the entity and its beneficial owner. Now then we have customer screening process. So sanction list screening. Mandatory check against RBI sanction list, FIU alert list and other regulatory watch list. And you should list the maintenance. Bank must maintain an updated system to regularly refresh and apply these lists. So in short we can say EDD involve detailed verification, research and screening to ensure high risk customer and transaction are properly monitored. Friends, if you really think that this video is useful for your understanding, please hit that like button so that this video can reach other AML KYC aspirant also. And friends, surely it will help you in upcoming examination. So make sure that you watch the video till the end. Now friends, let's talk about the companies group. Let's discuss the company group under KYC, focusing on juridical person. So companies. So companies nature is incorporated under the Companies Act 1956 or 2013, and with the separation of the ownership and management. What are the KYC document required? COI, Certificate of Incorporation, MOA, AOA, board resolution, power of attorney, right? OVD of the manager and officer authorized to operate. Who is the beneficial owner? So you should identify the natural person holding ownership and control through the company structure. For complex structure, the person exercising control is considered the beneficial owner. Exemption is, subsidiary of the listed company do not require BO verification. Suppose there is a listed company and it has a subsidiary. So such subsidiaries do not require BO verification. What about the partnership firm? Partnership firm are governed under the Partnership Act 1932. Registration is optional, but non-registration may cause legal or enforcement issue. If you look at the KYC aspect, so collect firm registration document, partnership deed, identity or address proof of partner, for authorized person. So in short, KYC for juridical person involve verifying both the entity and the natural person controlling it. Now, what is the meaning of juridical person? Some specific category. Like suppose take the case of LLP, Limited Liability Partnership. They are registered under the LLP Act 2008. If you look at the hybrid structure, so they combine the feature of both companies and partnership. And registration is compulsory for all the LLP. What are the documents required? So registration certificate of the LLP partnership deed, etc. So in short, we can say LLP must be registered and KYC involve verifying their registration certificate along with identifying partner and authorized signatory. Now let's talk about the trust. What about the association? Association are those not created under any act. It is often for cultural, social, professional activity. It is controlled by a managing body. For association, you require copy of resolution by the managing body, power of attorney for operational authority, OVD, officially valid document of the authorized person, and additional document. For association, I told you the beneficial owner. Who is the beneficial owner for association? Already we have discussed, right? So identify individual with 15% plus benefit or control, often not possible, right? What about the trust? Yes, very important concept. So if we talk about the trust can be created for many objective, right? Like beneficiary can be either a class of person or a specific identified individual. Funding may come from a single donor or public contribution or donation. What are the documents required? Registration certificate, trust deed, OVD of the trustee or authorized individual. Who are the BO? BO are called beneficial owner. And they identify any author, identify any settler, the creator of the trust. That is called author and settler. Then you should identify the trustee. Right, means always present must be identified, and beneficiary with more than 15% defined interest, he must be identified. If no clear BO is there, if no clear beneficiary owner is there, control attributed to managing body member, right? You can see beneficiary with greater than 15% defined interest, this is called BO. If no BO is there, then control attributed to the managing body member. Now, a special emphasis on the sources of the fund must be verified to ensure transparency and AML compliance. Now, juridical person in the case of ML and TF risk. So, why they are misused? Let's talk about money laundering and terror financing. Risk associated with the juridical person. Why they are misused? Because they can conceal the real individual behind the entity. Executive dealing with the bank may be unaware of the actual operation. Shareholder, partner, trustee may be benami or may be anonymous. So, hawala, some risky transaction like hawala movement. So means your informal value transfer, like trade-based money laundering. So misinvoicing or over or under invoicing, fraudulent financial flow, like hacked RTGS, forged check or forged instrument, fraudulent government claim, like tax refund, duty drawback scams, etc. Public fraud, like MLM scheme, fake investment collection, terror-linked activity, like fund collection, right, covert communication. There are some entity-specific risk also, like corporate and partnership firm. They often use for hawala, trade-based ML, and fraudulent activity. As association and trust, they are frequently linked to hawala channel or misuse of donation-based funding. So in short, juridical person can be misused in various complex way, requiring bank to apply enhanced due diligence and monitoring. Now, accuracy verification in KYC. So need for independent check. Customer declaration or document alone may not be reliable, so independent verification is crucial, especially for high risk cases. Degree of diligence, securities scrutiny should be proportional to the assessed risk. If you look at the proprietary firm, if you look at the characteristics and the risk, so most common is small business firm owned by a single individual. If you look at the KYC requirement, it is similar to individual KYC since the proprietor is the firm. What about the abuse and fraud risk? Yes, they are frequently exploited for hacked RTGS transfer, forged negotiable instrument, MLM and pyramid, MLM/pyramid and fake investment scheme, bogus job racket. So in short, independent verification is the key for KYC, and proprietary firm need extra monitoring due to the fraud risk. What about cross-border customer? Yes, very important. Certification or introduction, that means document must be certified or customer introduced through a regulated supervised entity with robust KYC system. Joint account and add-on card holder. So full KYC is required for every joint account holder and each add-on credit card holder. Foreign student account. So high ML and TF risk are there, so they require careful handling. What are the mandatory document? Passport with valid visa and immigration endorsement, recent photograph, admission letter from Indian education institution. What about the local address verification? So customer must submit a declaration within 30 days. Bank complete verification of the local address. What are the restriction pending address verification? Foreign inward remittance allowed up to $1,000 only. Cash withdrawal limited to $50,000 per month. So in short, cross-border and foreign student account require strict KYC, proper address verification, and restriction until the verification is complete. Right? These are the very important thing. Now friends, FPI. So one more thing is that foreign inward investment remittance is permitted up to $1,000 only. Inward remittance for foreign student, right? And monthly cash withdrawal is capped at rupees 50,000 until address verification is completed. What is FPI? Foreign portfolio investor. They must be SEBI registered. Only SEBI registered FPI with KYC done by SEBI approved custodian can only open account under the portfolio investment scheme. Now KYC reliance by bank. Bank can rely on SEBI custodian or intermediary KYC. Third party KYC reliance. This is allowed under PML rule provided conditions are met for due diligence and record keeping. Now what about the small account? I told you that a small account is designed to help individual without the OVD. They open a basic account. They act like an interim relief under financial inclusion measure. So only saving account can be open. Credit rating, credit ceiling, credit ceiling is maximum 1 lakh per financial year. Withdrawal and transfer limit is maximum 10,000 per month. Balance cap not more than 50,000 at any time. No foreign or inward remittance are permitted. Remember, these are the very important thing. So then we have the opening procedure. It can be opened only at the CBS enabled branches or branches where limits and restrictions can be strictly monitored. These are the very important points. Some more points about a small account. You must remember that signature and thumb point verification. It must be certified by a designated bank officer while opening the account. Initially it is valid for 12-month validity period. It can be extended for another 12 months if the account holder apply for an OVD within the first year. Maximum timeline, if suppose no OVD is submitted within 24 months, the account must be reviewed and the relaxation should be withdrawn. So in short, a small account requires certified verification. It has limited validity and must transition to regular KYC within 24 months. Let's talk about the self-help group. Self-help group relaxation at the account opening means no KYC verification needed for all the members. Only office bearer must comply. What about credit linking? For loan or credit facility, no additional KYC is required for member or office bearer. What about the new technology and card-based business? So if you talk about the new technology and card-based product, so there is a risk concern. Tech-based channel like net banking, mobile banking can provide anonymity. So there is a higher chance of money laundering and terror financing risk. And card-based product carry elevated risk. How to mitigate the risk? So that implement robust transaction monitoring and collect a specific detail about the customer occupation or business. So in short, we can say SHG enjoy KYC relaxation while tech and card product require extra monitoring due to high AML KYC restrict. Now let's talk about the direct selling agent. What is DSA? So DSA, the DSA selling card must undergo due diligence and KYC check. Cooperative bank, I told you, right? What about the cooperative bank? So they are set up to operate bank and society open account. AML law. Here is the reality. Almost every country agree that money laundering is a big problem, but the way each country makes and apply these law is very different. Why? Because every country has its own politics, economy and social setup. So that every country has its own politics, economy and social setup. So what happened, a global standard exists, but in practice there are huge difference from one country to another. That makes it very difficult to create a single uniform system worldwide. right? On the top of that, geopolitics. You know what is the meaning of geopolitics? It meaning country protecting their own strategic interest. It add another layer of complexity. Yes, so every country argue that it admit that yes, this money laundering is a big problem, but the way each country make and apply these laws is very different, right? So let's talk about Europe. To the context of Europe, the Council of Europe was set up way back in the year 1949, and today it has 47 country under it, right? Country of Europe, Council of Europe was founded in the year 1949, and today it has 47 country under it. Over the year, it has created more than 200 convention, right? 200 plus convention has been developed over the year, right? Basically, convention means agreements covering social, legal, economic issue, including those linked to the AML. So in short, we can say, while the world is united against the money laundering, the way law are framed and applied still look very uneven, right? So while the world is united against the money laundering, the way laws are framed and applied still look uneven. Now friends, let's look at the next point, next slide. So let's talk about the focus area. So when we talk about the global effort against financial crime, two major issues stand out. Yes, in the global effort against financial crime, two major issues stand out: money laundering and terrorism. So to tackle these, Europe came up with a special convention. For example, back in the year 1977, there was a convention on terrorism. This made sure that certain crime could not be excused as political acts, and it even allowed extradition. Meaning, what is the meaning of extradition? It means criminal could be sent back to the country where they committed the crime. That is called extradition. Extradition simply means criminal could be sent back to the country where they committed the crime. So back in the year 1977, there was a convention on terrorism. This made sure that certain crime could not be executed as political act, and it even allowed extradition. What is the meaning of extradition? Means criminal could be sent back to the country where they committed the crime. That is called extradition. Later in the year 1933, another big step was taken through the Money Laundering Convention. This focused on two things: going after the illegal money generated from the crime and putting a strong anti-laundering measure in place. What is interesting is that these conventions are not fixed in stone. They keep evolving with time so that new threat in finance and security can be handled, right? So that is called 1993 big step was taken through the Money Laundering Convention. The 1993 Crime Cooperative Convention took things further. It pushed countries to work together, whether it was investigating crime, tracing back black money, or freezing and confiscating asset. It also gave tool for mutual legal. In the year 1993, another big step was taken through the Money Laundering Convention. This focused on two things: going after the illegal money generated from crime and putting a strong anti-money laundering measures in place. What is interesting is that these conventions are not fixed in stone. They keep evolving with the time so that new threat in finance and security can be handled. The 1993 Crime Cooperation Convention, that's what we are talking about, right? This 1993 Crime Cooperation Convention took things further. It pushed countries to work together, whether it was investigating crime, tracking black money, or freezing and confiscating the asset, right? So it also gave tool for mutual legal support between the nation. So these conventions built a system where country can no longer fight these crimes alone. They must cooperate, share information, and act collectively. Now friends, let's set our focus to this 1993 convention, Crime Cooperation Convention. So let's move ahead and see how international cooperation against financial crime became stronger. The 1993 convention was very practical. It encouraged countries to share information, use common investigation method, and work hand in hand across border. It even allowed freezing of bank account and seizing of asset so that criminal could not quickly move or hide their money. Another key feature was that if one country confiscated illegal asset, other country could recognize that order and take domestic action also, right? Suppose one country confiscated the illegal asset, other country could recognize that order and take domestic action also, right? So this was the 1993 convention and encourage country to share information, use common investigation method, and work hand in hand. Then comes 2005. So an important revision of this convention. For the first time, a treaty not only targeted money laundering but also directly addressed terrorism financing. In short, we call it TF. even when funds were raised through seemingly illegal activities. This was a global first, right? The big takeaway is that access to financial intelligence, meaning quick information about suspicious money movement, became the most powerful tool to fight organized crime and terrorist network. Yes, very very important thing. That access to financial intelligence, meaning quick information about suspicious money movement, became the most powerful tool to fight organized crime and terrorist network. So step by step, this convention built a global safety net, making sure that no country, right, no country fight the battle alone. Now friends, let's talk about AML CFT legislative framework in the USA. Friends, if you are looking for unit-wise theory in PDF, short notes, MCQs, there are almost 2000 plus MCQs for the entire syllabus and previous year questions, memory based. If you are looking for this material for AML KYC, you can WhatsApp me on the number 8292857381. I again repeat, 8292857381, or in the description section of the video you will get link of the course. You can directly join the course, from which many aspirants have cleared the paper in just first attempt in last few attempts. So friends, now let's come back to our discussion. So we are talking about, let's understand how the United States built its anti-money laundering and counter-terrorism financial framework, that is called CFT. It all started with the Bank Secrecy Act of 1970. This law made it compulsory for bank and financial institutions to keep proper record, to report suspicious transactions, and to follow a strict KYC rule. The main idea was to keep track of the large cash movement both inside and outside the country. Then comes, Money Laundering Control Act of 1986. So what was this all about? This was the game changer because for the very first time, money laundering itself became a crime in the US. Yes, because of this Money Laundering Control Act 1986, money laundering became a crime in the US. It also made it illegal to break up big transaction into a smaller one just to avoid reporting. Yes, it made it illegal to break up big transaction into a smaller one. That means big transaction could no longer be break down into a smaller one just to avoid reporting. Something called a structuring. What is the meaning of a structuring? When I say structuring, it means breaking a big transaction into a smaller one. Why? To just avoid reporting. So it made it illegal that we can no longer break up big transaction into a smaller one just to avoid reporting. Plus, it allowed the government to seize illegal money and forced banks to strengthen their compliance system. 2 years later, Anti-Drug Abuse Act 1988, it widened the net. Now, not just bank but also business like car dealer, real estate agent, they have to follow the reporting rule. Even cash transaction above $3,000 require proper ID verification. So these were the part and parcel of the Money Laundering Control Act of 1986. What are the key provisions? I told you that for the very first time, the money laundering itself became a crime in the US. It made it illegal to break big transaction into smaller one. Then Anti-Drug Abuse Act comes into the picture. Not just bank but also business like car dealer and real estate agent had to follow the reporting rule. Now after 9/11 attack, the US Patriot Act, there is an act, that name was US Patriot Act of 2001 was introduced. That this tightened the rule further with extra due diligence requirement and stronger monitoring to stop terrorism financing. Now friends, let's look at Enhanced AML KYC Act in the USA. Friends, after the 1980s, the US kept making its anti-money laundering law even stronger. In the year 1992, the Anujo-Wiley Act came in. This was very important because it introduced Suspicious Activity Report, which we call SAR. Full form of SAR is Suspicious Activity Report, which are still the backbone of AML reporting today. It also added a stricter penalty, made record keeping for wire transfer compulsory, and even set up a special advisory group to guide AML policy making. Right, so you can see. So friends, what was this act all about? This was called, Anujo-Wiley Anti-Money Laundering Act. So this was very important because it introduced Suspicious Activity Report. I told you SAR, which are still the backbone of AML reporting today. Also, this act added stricter penalty, made record keeping for wire transfer compulsory, and even set up a special advisory group to guide AML policy making. Then in the year 1994, the Money Laundering Suppression Act focused on the banking system. It made sure that bank examiner got better training, created awareness program, and improved how suspicious cases were referred to the law enforcement. By the year 1998, Money Laundering Strategy Act took things to the next national level. For the first time, the US created a national money laundering strategy. What was the name? National Money Laundering Strategy, which was a proper roadmap for fighting the financial crime. It also introduced a special task force that is called HIFCA, High Intensity Money Laundering Task Force, right? So basically, a proper roadmap for fighting the financial crime. It also introduced, I told you, it introduced HIFCA, which targeted high risk area and industries more aggressively. So step by step, the US kept tightening the net, making sure that money laundering became harder, riskier and more visible. Now friends, then comes USA Patriot Act 2001 key provision. So let's talk about one of the most powerful AML law, that is called USA Patriot Act of 2001. This law came right after the 9/11 attack and its main focus was simple: to cut the money supply of the terrorist. See, how did it do that? So first of all, it made financial terrorism a federal crime. Yes, it made financial terrorism a federal crime. Then it forced banks to follow a stricter KYC rule. So you can see, it made terrorism financing a federal crime. It forced banks to follow a strict KYC rule, verify customer carefully, and stop doing business with shady entity like the foreign cell bank. High risk account got extra due diligence, and the bank were pushed to share data with the government more openly. Right. Another big move was that it encouraged banks to share suspicious information with each other, which made it harder for criminals to hide. The act even introduced a special measure, basically extra tools the government could use against the money laundering threat, that is called special measures. And while assessing banking transaction, a regulator also started looking at how strong a bank AML history was. Now shifting our focus to the UK, their major law is Proceed of Crime Act 2002. Right. This law gave very wide power to seize or confiscate asset if they were linked to the crime. Plus, it made money laundering itself a clear criminal offense with well-defined categories. So both the US and the UK built a strong framework, but while the US focused more on terrorism financing post 9/11 attack, the UK created a broader net to catch all kinds of criminal proceed. Now, let's look at UK AML CFT framework. So till now we have talked about USA. Friend, let's look at the UK and Australia AML framework. In the UK, two major laws stand out. First was the money laundering regulation of 2007. This law did not just apply to the bank, it also extended to auditor, lawyer, estate agency and even casinos. The idea was clear that criminal money can flow through many channels, so the law covered both financial and non-financial sector. Right. So then there was the Terrorism Act of 2000. So this is permanent anti-terror law. It allows the government to ban terrorist group, control fundraising for them, and even restrict firearm training linked to terrorism. Moving to Australia, their main law is the AML CTF Act of 2006. So this created 5 core obligations for businesses. Like, what were the 5 core obligations? Like customer identification, right? Reporting suspicious transaction and ongoing monitoring. To guide firm, detailed compliance steps were later issued under the 2007 AML CTF rule instrument. Australia also took a special step, right, in the year 2014. For example, a stricter rule on transaction linked to Iran and restriction on dealing with residents of certain high-risk country. Finally, to ensure the system work, Australia review its AML framework internally and also goes through the external check, like FATF evaluation in the year 2014-2015. So both the UK and the Australia built wide-ranging framework covering not just bank but also other profession and sector where dirty money can be hidden. Now friends, let's look at AML safety legal framework in India. So let's talk about how India fight money laundering and terror financing. The backbone of our system is the Prevention of Money Laundering Act 2002, or we call it PMLA. This law is fully in line with the FATF standard and the global norms. This PMLA Act is fully in line with the FATF standard and the global norm. It gives India the legal power to track, to seize and to punish money laundering activity. Right. Along with this, amendment to the Unlawful Activity Prevention Act, that is called UAPA. Again, I am repeating the full form, Unlawful Activities Prevention Act. Amendment to the UAPA strengthened the anti-terror measure. UAPA full form, Unlawful Activities Prevention Act. So these changes ensured India could block terror funding and freeze assets, just as recommended by the international bodies. India also implement UN resolution, right, especially those related to drug trafficking and financial crime, making sure we fight not only local but also global threat. An important role here is played by the Indian Institute of Banking and Finance, IIBF, right. It trained banker and institute on AML, CFT, KYC compliance, ensuring the system work on the ground. All this reflects India's strong global commitment. We are not fighting this battle alone, but standing shoulder to shoulder with the world in tackling the illicit finance. Right. Now friends, and remember, our present AML CFT regime stand on the foundation of earlier law, which laid the base for today's robust system. If you look at the comprehensive AML CFT provision in India, yes, just have a look at it. So India fight against money laundering is not limited to one law. It is complete framework. Various law on tax, foreign exchange, criminal offense already carry AML and CFT element. But the Prevention of Money Laundering Act 2002 PMLA is the backbone. This act is supported by detailed rules and guidelines. Oversight come from multiple regulators like RBI for banks, SEBI for capital market, IRDA for insurance. So each issuing sector specifies compliance direction. At its operational level, the Indian Bank Association also provide guidance to help banks follow these norms effectively. Now friends, about the PMLA itself, it was enacted to meet UN resolution and align with the 1998 Global Political Declaration and the Action Plan. Right, it was enacted in the year 2002 to meet the UN, to address the UN resolution and align with the 1998 Political Declaration. Right, it usually came into force on the 1st July 2005, formally making money laundering a crime in India. So in short, we can say India's AML CFT system is a broad, regulator driven and globally aligned, with PMLA as the central pillar. Now let's look at the key legal provision under PMLA. So first of all, it defines money laundering as a crime and prescribes punishment for those involved. Second, it gives the government power to attach, to seize or to confiscate any property connected with laundering. So that is what money laundering does. It defines money laundering as a crime and it gives the government power to attach, to seize, to confiscate any property. Under PMLA, all the reporting entities, who are the reporting entities? So bank, financial institutions, certain businesses, these are the reporting entity. So all the reporting entities must share transaction data with FIU-IND. What is FIU-IND? Financial Intelligence Unit India, which is India's financial intelligence unit. So the act work on two fronts. What are the two fronts on which the act work? The first is linking laundering to the predicate offense, and second thing is to ensure reporting entity meet their compliance duty. So this act work on two front. The first front is linking laundering to predicate offense, and second front is to ensure reporting entity meet their compliance duty. Now if we talk about the implementation, PMLA give agency a strong power for search, seizure and collecting evidence. The director of FIU-IND plays a key role in overseeing compliance and enforcement. Finally, the act is very clear in defining what count as an offense and places heavily responsibility on entities like bank and even some non-financial business to stay compliant. So in short, we can say PMLA is not just about punishing launderers. It builds a whole system of reporting, enforcement and prevention. Now friends, let's switch our focus. Let's talk about who exactly the PMLA applies to and how it has evolved over the time. The PMLA is not limited to just bank. It covers a wide range of financial institutions and even some non-financial business. All these are legally called reporting entity, right? All these financial institutions and a non-financial business, they are called reporting entity, which means they must follow the strict compliance rule. Over the year, PMLA has been amended many amount of time, right? Like in the year 2005, 2009, 2013. A major review happened in the year 2009, where India's system was assessed by the global watchdog FATF, right? So what I'm talking about, PMLA has been amended multiple times, 5, 9 and 13. And major review happened in the year 2009, where the India's system was assessed by the global watchdog FATF. These amendments made the law stronger, They expanded the meaning of money laundering to not just creating illicit wealth but also hiding it, holding it, or using it. So, in short, we can say these changes ensured India's law matched the global standard and kept up with the international best practices to fight money laundering and terror financing. Now, let's look at how align with the global standard. So, now let's see how the PMLA align with the global standard. So, the law has been amended from time to time in sync with the international AML and CFT convention. This shows India's commitment to continuous reform and a stronger enforcement. Some key highlights of PMLA amendment are proceed of crime, which says that definition has been expanded in line with the Palermo Convention. Second point is stricter punishment, means fines have no upper limit and penalties depends on the seriousness of the offense. Third is the institutional liability, which means even corporate can be prosecuted independently without needing an individual conviction. And the threshold removal, which means earlier 30 lakh limit has been removed and now offences apply regardless of the amount involved. So in short, PMLA has evolved into globally aligned no escape framework for tackling the money laundering. Now friends, let's talk about how the reporting obligation under PMLA has been strengthened. So section 12 makes it mandatory for all reporting entity to maintain detailed record of transaction, including those reported to FIU-IND. This is section number 12. The main focus here is on tracing the proceed of the crime. Coming to the PMLA amendment, inclusion and ownership. So first of all, we have the beneficial ownership. Every entity must identify and record who the real owner is, but keep this detail confidential. Then we have second point called wider financial scope. Not just bank, but also forward market commission, PFRDA, recognized stock exchange, and even Indian Post now fall under PMLA. Third thing is the non-financial coverage. It is extended to designated non-financial business and profession like real estate, casinos with the same record keeping duty. And finally, a new category was introduced, person carrying on designated business or profession, making sure that compliance requirement goes beyond traditional financial institution. So in short, PMLA has moved from being bank focused to becoming a comprehensive compliance framework for almost all the financial and non-financial players. Now let's talk about the new entity category. So let's talk about the new entity category under the PMLA. These include people like registrar, sub-registrar, real estate agent, dealer in precious metal or stone, and those handling cash or security for other. Basically, all sectors like real estate, precious good trade now fall under strict monitoring, meaning they too must follow anti-money laundering rule. On compliance, FIU-IND has been given more power. They can demand transaction record, extra detail, and reporting entity must keep all FIU communication strictly confidential. And when it comes to penalties, director and designated director now have the authority to impose sanction, right? And not just on institution but also on their employee. So in short, the net is widening, right? The net is widening, compliance is tightening, and accountability is now on both institution as well as the individuals. Now let's move to the legal safeguards. Under PMLA, directors and employees are protected, meaning if they share information with FIU-IND, they won't face any civil or criminal consequences. This ensures people cooperate without fear. Now on the enforcement assistance, the circle has expanded. Apart from bank, now authorities like IRDA, which is called insurance regulator, then Department of Post, PFRDA, registrar under the Registration Act, they are also bought in. IRDA, Department of Post, PFRDA, registrar, sub-registrar, right, they have also bought in. And that is not all. Even motor vehicle authorities, recognized stock exchange, professional institutions, they are also included to support the enforcement. Finally, let's understand who is a reporting entity under the section 2WA of the PMLA. Banking company, financial institution, market intermediary, and individual in the designated business or profession. These are called reporting entity. Who are banking company, financial institution, market intermediary, and individual in the designated business or profession. So basically, if you are in finance, insurance, real estate, or even certain professional ethic, such as certain other professional role, you are accountable under PMLA compliance. Now friends, what is the section 2 under subsection WA? Let's look at it. So basically, this section tells you that it includes, I told you already, this includes bank, financial institution, intermediary, specified non-financial businesses. Now let's look at the key obligation of the reporting entity. First is the record keeping, which is under section number 12. So they should maintain transaction record for a minimum period of 5 years. Then transaction reporting under section number 13. So what it says that they have to submit prescribed transaction detail to the FIU IND. So first of all, they have to maintain record for 5 years, section number 12, and section number 13 says that they must submit prescribed transaction detail to FIU IND. Then we have CDD. What is CDD? Customer due diligence. That means they should verify identities prior to and during business relationship. And finally, we have business ownership, which means identify and verify the ultimate business beneficial owner behind transaction and account. Now, what are the additional obligation of the reporting entity? So let's talk about the additional obligation of the bank under PMLA. First, bank have to preserve customer record for 5 years. Even after the account is closed, they have to preserve customer record for 5 years. This is to make sure that if anything shady comes up later, the data is still available. Second, all the information collected about customer must be kept confidential. Bank can't just leak or share it anywhere. Third, whenever the FIU IND, Financial Intelligence Unit, asks for detail, bank are bound to provide the information. But still, the confidentiality rule apply. So 3 points I have talked about: record retention, which means bank have to preserve customer record for 5 years. All the information collected about the customer must be kept confidential, right? And whenever FIU IND asks for detail, bank are bound to provide the information. So now what happens if the bank does not follow this rule? So the director of FIU has the power to take action. This could mean a formal warning or directing the bank to take corrective action and the remedial step. So in simple word, we can say bank must maintain record, keep them private, share with FIU when asked, and face consequences if they ignore this obligation. Now let's look at the corrective and punitive measures under PMLA. So if a bank or financial institution fail to follow the rules, the FIU director can step in. First, the bank has to report back about what corrective step it has taken. But here is the serious part. There are financial penalty. The fine can start from rupees 10,000 and can go up to 1 lakh for every single violation. So the non-compliance is very costly. Now come to the offense of money laundering under the section number 3. So what does it mean? If anyone is directly or indirectly involved in handling money that comes from crime, whether by hiding it, keeping it, acquiring it, using it, it counts as money laundering. Even if you try to project dirty money as a clean money, that is also an offense. And the new law treats it very seriously. It is a cognizable and non-bailable offense. So the scope is very wide. So I told you that the scope is very wide, right? It's not only about the actual laundering, but it also attempting and helping or even being associated with it. So in short, PMLA ensure that banks stay compliant, and anyone trying to turn black money into white will face a strict action. Then we have the protection of the untainted property. Let's understand a very important concept under PMLA, that is protection of untainted property. In simple word, if someone try to show illegal money as if it is clean and legal, but that itself is money laundering. For bank, this is a serious issue. They must strictly follow anti-money laundering rules. If they are careless, it may look like the bank is indirectly helping in money laundering. What about punishment? Punishment is also very strict. Anyone guilty can face minimum 3-year jail, which can go up to 7 years or more for serious crime like drug trafficking. On the top of that, there are very heavy fine also. Now, where does this illegal money come from? So that is where the concept of predicate offenses comes in. Predicate offenses, right? So basically, predicate offenses are basically the original crime from which the dirty money is generated. Under PMLA, these crimes are listed in the schedule. So there are two schedules, Part A and Part B. So Part A include terrorism, drug trafficking, financial scams, property crimes, and crime against the individual or the state. And Part C is about, it deals with a cross-border crime. So any property, any money linked to these offenses, any kinds of property or any money linked to this offense is automatically treated as proceed of crime, right? Now, so in short, we can say money laundering is not just about handling dirty money, but also about trying to make it look clean. And the law ensures that a strict punishment for both individual and the institution involved. Now let's look at the key provision of PMLA, extensive coverage of PMLA. Do you know that how wider the coverage of PMLA really is? Well, it includes 156 different offences from 28 law. So that is a huge net. Under section 5, the director has the power to attach and freeze any property suspected to be linked to with the money laundering. So this is the power of the monitor. The director under section 5, the director has the power to attach and freeze any property which is suspected to be linked with the money laundering. Then come adjudication. Adjudication means where it is decided who really own the property and whether it is cleaned up or tainted or not. If it is proven tainted, the law allows confiscation of the asset. And here is the catch. This can happen even without a conviction for money laundering. Once confiscated, the property goes straight to the central government, which manages further. Now, to ensure fair justice, special courts are set up under PMLA. And if anyone is unhappy with a tribunal order, they can appeal directly to the Supreme Court. So friends, adjudication we know. If it is proven tainted, the law allow confiscation of asset. There are special court which are set up. So to ensure faster justice, a special court are set up under PMLA. And if anyone is unhappy, he can appeal directly to the Supreme Court. Now friends, so PMLA is not just strict, it is extensive, powerful and far-reaching. Right. Now let's talk about the appellate and international cooperation under PMLA. So if someone is not happy with the decision of appellate tribunal, they can directly challenge it to the Supreme Court. PMLA also has reciprocal arrangement, right, with the foreign country. This means India can work with any other nation to for property attachment, confiscation, or even So PMLA also has something called reciprocal arrangement with the foreign country. This means India can work with other country for property attachment, confiscation, or even extradition of the accused. So on the investigation side, officer associated appointed by the central government have a stronger power. They can search, they can seize, they can issue someone in money laundering cases. So I hope this is clear. Summon authority, right? So basically I told you officer is appointed by the central government have a strong power, right? And remember PMLA has an overriding effect, which means if there is a clash between PMLA and any other law, PMLA will prevail. Lastly, PMLA rule came into effect on 1st January 2005, making it compulsory for bank and financial institution to maintain proper record and to report suspicious transaction. Now let's look at the purpose of PMLR. Now friends, let's look at the purpose of the PMLR. So let's talk about the prevention of the money laundering rule or PMLR. This rule came into effect from 1st July 2005. So what is the purpose of this rule? Very simple. They give us a detailed step-by-step procedure on how the PMLA Act will actually work in practice. For bank, PMLR is like the foundation of all the AML and KYC system. The policy, the process, the check, everything starts from here. And yes, these rules are not fixed forever. They keep getting updated. For example, the latest big amendment was in the year July 2015. Why the changes? To stay aligned with the update in the PMLA Act and also to match global FATF standard. Some of the major changes includes new and updated definition like client due diligence, officially valid document and transaction. A fresh concept called designated director who ensure compliance in the bank. And a clearer rule on cash transaction reporting, especially when multiple transactions are connected together. So in short, PMLR is the rule book that ensures banks are always alert and compliant when it comes to money laundering prevention. Now friends, let's shift our focus to the key amendment to the PML rule. So let's talk about amendment to the PML rule. And trust me, this is very important for all bankers and AML KYC aspirants. So first, new reporting requirement were introduced. This means bank now have to report cross-border wire transfer and even those transactions which is reported by which is done by the NGO, so that no suspicious money slips through. Second, they have to take currency reporting was tightened. Fake currency reporting was tightened. Earlier it was done randomly, but now new bank mostly reported it smoothly. Third, delays are no longer tolerated. Delays will no longer be tolerated. Right. If any bank file report late, it is officially treated as a violation. Now next come to the CDD. What is CDD? Client due diligence, which is nothing but the KYC process. So friends, customer due diligence, which is nothing but the KYC process, it says clear timeliness are set for verifying customer identity. Bank can rely on third party KYC, but rules are clearly defined. Identifying the real owner behind account, though it's called beneficial owner, is not mandatory. Bank must use a risk-based approach, profiling customer based on their risk level. Have an existing client are not exempted, their KYC must be updated. Second thing, there is something called SDD, which is called simplified due diligence. More documents are now allowed for easy verification. And importantly, if someone does not provide valid KYC document, the bank can even close their account. So overall, these changes makes your bank are strict, smart, more accountable in preventing money laundering. Now friends, let's talk about the key provision under PML rule. The first is called CDD, client due diligence. This simply means bank and financial institution must carefully verify the identity of their customer. Whether it is for opening an account, even for a single transaction, the rule clearly mentions what documents are needed for individual and for company. Then we have officially valid document, or we call it OVD. These are the officially accepted proof of ID and address. For simplified KYC, some extra documents are also allowed. To make things easier, the government has set up a central KYC record registry. This is like a national database where your KYC details are stored and updated so that you don't need to repeat the process again and again. So the rule also extends to the digital KYC storage, meaning all the records are now maintained in electronic form. Each customer get a unique KYC identifier that link to their shared record or stored record. Then finally, there are something called reporting obligation. Bank and institution must file regular reports and immediately flag any suspicious transaction to the authority. So in short, PML rule ensure that customer identification is foolproof, data is stored securely, and suspicious activity don't go unnoticed. Now friends, let's move further. Let's talk about some important rule under the Prevention of Money Laundering Act. Suspicious transaction. So bank must report suspicious transaction, any activity that might look unusual or risk has been requested. Second thing is that bank are required to keep detailed record of all transactions. So in terms of basically client identification, right? So that client identification is a must. Proper document has to be maintained for every customer and transaction type. Now about compliance inside bank, a designated director or a whole-time director is appointed to oversee the AML compliance. A principal officer ensure that all reports reach FIUIND on time. There are some extra provision, like a small account have a special condition and restriction since they are considered low risk. And all of these align with the RBI KYC AML guideline that the bank must follow. So in short, these rules ensure that bank stay alert, track suspicious activity, and work closely with the regulator to fight money laundering. Now let's look at UAPA overview. UAPA was enacted in the year 1967, which is called Unlawful Activity Prevention Act. 2008 it was amended. It added provision on terrorism financing, right? And core provision is to criminalize the terrorism related activity and fundraising. Property measures, attachment and seizure of asset linked to the terrorism. 2013 amendment, updated as per FATF standards. Now, section number 40 of UAPA, which is the fundraising for terrorist organization. It criminalizes raising fund for terrorist organization. What are the act cover under it? Like inviting or persuading other to provide money or property, or receiving fund and property with intent to aid terrorism. Now friends, let's switch our focus to the section number 40. Till now, more point about section number 40. So I told you fundraising for terrorists and organization, like providing money or property, right? So it includes direct or indirect support, raising money via counterfeit Indian currency. And what is the penalty? Penalty is imprisonment up to 14 years, fine or both. Then comes section number 51A of UAPA, which provide you the preventive power. So there is something called central government authority. Means central government can impose preventive measures against terrorism. What is the scope of it? See, restriction on fund, property and related dealings. Now friends, let's talk about AML CFT organizational structure in India. Basically there is something called legal framework. Means anti-money laundering and counter-terrorism financing concern are tackled through multiple law. Ministry of Finance lead coordination with FATF and regional body. They have a dedicated FATF cell for policy alignment. They monitor the implementation of FATF recommendation. Ministry of Finance handle the evaluation to strengthen India's global reputation. Now then comes Ministry of Home Affairs. They manage terrorism related provision, focusing on internal security. Now, if we talk about FIU India, it was established, it was set up in the year 2014 by the Ministry of Finance. What is the function of it? The function is to, it acts like a central agency for receipt, analysis, dissemination of the financial intelligence. And it operates independently, reporting directly to the Economic Intelligence Council. If we talk about the mission, so what is the mission of it? So mission is to deliver high quality financial intelligence to combat money laundering, terrorist financing and major economic crime. The vision is to evolve into a globally recognized and efficient FIU. Right, let's look at the core focus area: effective collection and processing of information, a stronger domestic and international cooperation, capacity building support for reporting entity, ensuring compliance with the reporting norms, enhancing organizational resources and IT infrastructure. Coming to the core function, FIU act like a central repository for report like CTR, CBWTR, STR, IPR. Next, it perform analysis, means examining data systematically to detect suspicious pattern and laundering activity. Finally, there is something called dissemination, means sharing actionable intelligence with enforcement agency such as the Enforcement Directorate and the Directorate of the Revenue Intelligence. So remember, collect, analyze and disseminate. These are the three pillars of FIU-IND. First of all, they collect, they analyze and they disseminate. Now friends, so we are talking about the mission, we are talking about the core focus area, right? So you can think of FIU-IND as, financial detective of the India. Its mission is to dig deep into the money trail and catch criminal who try to hide the black money. Some additional function of FIU-IND. So FIU-IND is not just sitting with data. It's like the central brain of the financial intelligence. First role is information sharing, which means it works hand in hand with the intelligence agency, police, regulators and even foreign country. Why? Because money laundering and terrorism does not stop at the border. So FIU makes sure that the dots are connected across India and the globally. Second is the central database, which means you can think of India's locker of the financial intelligence. All cash transaction report, suspicious report, everything goes into one giant national repository that makes tracking easier. That is called central database. Coordinating role. What is the meaning of coordinating role? Very very simple. It is like team leader in the group project. So in this case, what happened? So that is called team leader. In case basically we are talking about coordinating role. This is like a team leader in the group project. What is the fourth role? The fourth role is of that research and monitoring, which means not just storing data. FIU-IND is constantly studying new tricks used by criminal, whether it is new money laundering method, emerging trend or typology. Now let's talk about the technology. Something called FinNet 2012. So this is like an online reporting platform. Bank and institution don't send file physically. Everything is reported digitally for speed and accuracy. What about the next point? That is called FinCore, or we call it financial core, which means you have an advanced tool. This is an advanced tool. FinCore is an advanced tool used to analyze all the reports. Imagine a super smart filter that picks out suspicious activity from lack of transaction. And finally, we have the deep data handling, which means FIU don't just forward report as they are. They also do the detailed analysis, connect all the inputs, and then pass only refund or affordable intelligence. Now friends, let's switch our focus to the FIU-IND analysis of the STR. So basically, what are the key trends? Have a look. Rising volume means continuously increase in STR receipt. Then you have improved quality, which means that focus on the priority sector, improved standard of reporting. Then we have tried trend snapshot 2010, 2011, 2013 to 2014. Significant year-on-year growth in STR rating, right? And then we have common patterns. What are the common patterns? So most STR are flagged due to unusual complexities, no clear economic rationale. So friends, then we have the trend snapshot. As you can see that significant year-on-year growth in STR figure. Common pattern is that most STR are flagged due to unusual complexity and no clear economic rationale. So what is the impact of STR dissemination? See, dissemination decision depends on the type of suspicion, nature of offense, transaction pattern, monetary value, linkage with other intelligence. So if you look at the 2013-2014 outcome, then you can see the data. I think this question will not be asked. Now let's look at the significance of the CTR. Very, very important. So threshold reporting, which means capture high value cash transaction above the prescribed limit. Then we have intelligence source. It provides vital leads to basically FIUIND. What about correlation? So if we talk about the correlation, it means it help in linking with STR for deeper investigation. And then we have the origin profile. So mostly filed by the public sector bank. Now if we talk about the FIUIND PMLA compliance strategy, there is something called awareness building, AML CFT training, outreach program, a special focus on high risk cases. Then we have ensuring reporting, which means regular interaction with the institution, sensitization of the top management. Then we have detection of the breaches. Detection of breaches means through law enforcement input, code analysis of the report. Then we have something called sanction framework. So first chance to rectify the lapses, warning or penalty for serious violation, and post any kind of post sanction monitoring 6 to 12 months. Now let's talk about the ED. ED is called Directorate of Enforcement. So ED was first set up way back in the year 1956. In the beginning, its main job was to keep an eye on the foreign exchange transaction under FEMA. That is called FERA, right? Later, it also took responsibility under the FEMA 1999. But its role became much bigger when the PMLA or Prevention of Money Laundering Act came into play in the year 2002. Under this law, ED get the power to investigate and act against money laundering activities. The ED work under the Finance Ministry, Department of Revenue. Its core functions include collecting intelligence, investigating offences, right, like terms. So basically, but its role become much big. I told you, the ED work under the Finance Ministry, Department of Revenue. It also handle cases under old law like FERA and FEMA, and even preventive detention under FEPUSA. Right. So in short, ED is the country's watchdog against money laundering, illegal forex deal, and big financial crime. Then we have SFIO. This is called Serious Fund Investigation Office. So basically, let's talk about two important investigation agencies in India: SFIO and NIA. So SFIO, or Serious Fraud Investigation Office, it work under the Ministry of Corporate Affairs. Simply put, in today's India's detective agency for big corporate and scam and fraud. So it has expert from law, finance, accountancy, and forensic auditing who join hand to complete the complex task. Right. So remember this very, very important thing. So SFIO does not deal with every small case. It takes up serious fraud case that are complicated, involve multiple area, and affect the public or public to explore a loophole in the system. On the other hand, if we talk about the National Investigation Agency, or you call it NIA. So it is the India Counter-Terrorism Agency, formed in 2008 after the Mumbai terror attack. Its main job is to investigate and prosecute cases related to terrorism and threat to the national security. Right. It deals with terror activities. So that is all about NIA. NIA is India's counter-terrorism agency. Now friends, let's switch our focus to more point discuss about NIA. So NIA, you think of it as the India's main detective force against terrorism. Not only does it deal with the terror attack within the country, but it also investigates cases that have international link. The NIA does not just stop at the terror attack. It also handle related crime like arms and drug trafficking, fake currency racket, illegal border infiltration. So that is all is handled by NIA. So let's move to something especially important, that how India fight money laundering and terror financing. Back in the year 2013, what happened? That the following global FATF standard, India adopted a risk-based approach in documents. Then what happened, an AML steering committee, right, was set up under the Ministry of Finance in the year 2020 to 12 to regularly review risk and check if the laws like PMLA are working effectively. Key player like RBI, SEBI, FIU, IND, right. So these were the so key players basically these were the key players, right. In 2013-2014, a special working group was created for sectors like banking, insurance and capital market. By 2015, India formed a national risk assessment working gap, right. So with 8 expert team coordinating access ministry, right, coordinating across ministry to keep a close watch on the financial crime from the across the different sectors. Now friends, did you know that India is deeply connected with the global network to fight money laundering and terrorism financing? First, India became a full member of FATF in the year 2010. That is the world watchdog against dirty money and terror fund. Even before that, in the year 1998, India joined APG, which is called Asia Pacific Group, and later co-chaired from 2010 to 2012. Our FIU IND is super active here, especially in evaluating how will country fight the financial crime. So that is called, before that I told you APG, Asia Pacific Group, right. India FIU is also the India FIU also joined to the Egmont Group in the year 2007, which is the global hub of the financial intelligence unit. It today even represent Asia's in Egmont committee alongside the Qatar. On the regional side, India participated with the BIMSTEC terror financing subgroup to counter terror in the South Asia. Now friends, I hope it is clear. So FIU IND does not just work within India, it shares financial intelligence with other country, right. So FIU IND also signed bilateral MOU with country where the India have a strong trade relation to track the money trail behind the Afghan rule trade. So in short, and yes, India is a part of the bilateral trail with the Russia and the USA to track the money trail behind the Afghan drug trail. So in short, India is not fighting financial crime alone. It is a part of the global network. Now look at the correspondent banking. So it is an arrangement where a correspondent bank provides service to the respondent bank. Correspondent bank provides service to the respondent bank, right. What are the services? Cash and fund management, right. International wire transfer, demand draft and mail transfer, payable through account, and check cleared and settlement support. So now discuss what is the due diligence on correspondent bank. So tell me, what is the due diligence on correspondent bank? See, the need is the higher transaction volume plus complexity. This causes the risk. Right. So that is the point. Due diligence on correspondent banking we are talking about. So need is high transaction volume plus complexity. Technology means instant cross-border transfer, and it causes higher exposure. Now what are the parameters for evaluating correspondent bank? Let's have a look. So there are some parameters. Whenever bank choose another bank to partner with, they don't just jump in blindly. They carefully check a few important things. First, they look at the business value, right. Is the partnership really worth it in the long run? Second, they also come across the nature of the business, which means so that it looks clean. They hide where the money really came from and make it look like it is from legal business. For example, during the Prohibition era in the US, when alcohol was banned, gangsters made millions selling it secretly. To hide the source, they ran laundromats, yes, washing cloth, and sold those business as the source of income. That is actually where the term money laundering became popular, right. So this was during the Prohibition era in the 1972, where when alcohol was banned, gangsters made millions selling it secretly. To hide the source, they ran actual laundromats, washing the cloth, and showed that these business as the source of the income. This is not just history, it is happening still today. From drug dealer to big time fraudster, many use money laundering to avoid getting caught. The term itself became famous in the year 1972 during the Watergate, in the 1972, during the Watergate scandal, and was officially recognized in the US law in the year 1982. Right, Watergate scandal happened in the year 1982. Right. So it was officially recognized in the US law in 1982. So let's quickly revise the point which we have covered. So what I told you, that criminal want illegal money without getting caught. First point. Money laundering means hiding dirty money through source. Second point. Third point is famous. It was famous in the Prohibition era with laundromat as cover. Fourth point. It is still common today, especially in drug trade. Sixth point. Term popularized in 1972 Watergate and in law by 1982. So friends, let's quickly revise the point which we have just covered. I told you that criminal want illegal money without getting caught. Money laundering means hiding dirty money through source. Famous in Prohibition era where laundromat as cover is still common today, especially in drug trade. And this term was popularized in the year 1972 Watergate and in law by 1982. Now friends, let's move to the next slide. And now, have you ever wondered what criminals do with all the money that they make from illegal activity? Well, they don't just keep it lying around, because if they suddenly start spending large amount of cash, the police will come knocking. Right, that is where money laundering comes in. It is a process of taking the dirty money earned from crime and making it look like it came from a legal source. This way, it became hard for authority to trace it back to the crime. This is not new. In fact, it goes back to the ancient time where traders used a scam to hide their profit. One of the most famous examples come from the Prohibition era in the US. Right, so let's talk about the Prohibition era in the US. What happened? Alcohol was banned, but gang made huge profit selling it secretly. Right, so that is the point. Now friends, let's talk about how the term money laundering comes to picture. So when we talk about money laundering, we are talking about the global term used to describe turning illegal money into legal looking money, usually by moving it through a series of complicated transactions. As you can see, layered transaction. You can think of it like a cycle. Dirty money goes in, it move around in layer and come out looking clean. This trick is a favorite of criminal organization because it let them spend their illegal earning without raising suspicion, right? So they hide asset, they invest extra fund into legal business, and they keep their money active instead of just letting it sit, all while staying under the radar, right? So we are talking in the context of these money launderers. They hide their asset, they invest extra fund into legal business, they keep their money active instead of just letting it sit. But here is the bigger danger. What is the bigger danger? In countries where rules are weak, money laundering can mess up the economy, politics and society. It is bad for honest businesses because it creates unfair competition, it pushes price in a strange decision, and it slows down the real economic growth. Right, it also make life harder for central bank. Obviously for central bank also it make life harder because it create instability in the money supply. And when the dirty money move across border, right, when the dirty money move across border, as you can see, it can make exchange rate jump around more than the normal trade rate. So let's summarize the point which we have covered in this particular slide. I told you money laundering means turning illegal money into legal looking money. It is done through layered transaction to hide the source. It let criminals spend without suspicion. It hurt economies. It hurt politics. It hurt fair competition. It causes price distortion. It slows the real growth. It adds instability to the money supply and exchange rate. Now friends, let's talk more about this money laundering. So money laundering does not just clean dirty money. It fuel corruption. It fuel organized crime. But the question is how? So by allowing corrupt officials to hide their stolen wealth and giving criminal network a safe way to handle their profit. Countries that are easy target for money laundering often see a rise in the financial fraud, right, and serious social damage. This scare away honest investors who don't want to risk their money in such environment. Worse, when criminals gain influence in these regions, they can slowly weaken democratic institutions and the government system. In fact, when organized crime sneaks into politics, it is a direct threat to the stability and the future of the democracy. The tricky part is because money laundering is so secretive, no one knows exactly how big the problem is. Experts estimate it could be anywhere between hundreds of billion to over 2 trillion US dollar every year. Bank and financial institutions are especially vulnerable because disguised illegal money often passes through them. And with globalization and new technology, criminals can now move dirty money across border almost instantly, making it even harder for authority to track and stop it. So let's quickly summarize the point which we have covered in the third slide. I told you that money laundering hide wealth of corrupt official and fund criminal network, lead to more fraud, social harm, scare away investor, Criminal influence can weaken the democracy. Global estimate says that 100 weak system to detect money laundering can be a disaster for a bank and other financial institution. Why? Because even without realizing it, they might end up processing criminal money. And in the financial world, that is a nightmare for reputation. So when money laundering become common, it increases the risk of fraud and even threatens the stability of the financial system. In a loosely regulated market, the danger is even higher because criminals can slip their money into the system without much resistance. And here is the scary part, that whether a bank is linked to dirty money on purpose or by accident, the purpose backlash can be huge. Trust is everything in banking, and once the trust is lost, it is very hard to get back. That is why compliance failure don't just damage a bank name, they can lead to heavy legal penalty and strict action from the regulator. To protect themselves, bank need a strong ethics, legal compliance, well-trained staff, and advanced system to monitor transaction. According to the 1988 United Nations Convention, money laundering specifically includes converting or transferring asset from drug crime to hide their origin or protect the people involved. It also covers hiding the source, location, movement, ownership of asset from any criminal activity. So let's quickly summarize the third slide which we have just discussed now. I told you that if you have a weak control, there is a risk of processing criminal money. Laundering increases fraud. Laundering threatens the financial stability. Loosely regulated market are higher risk. Even accidental link to crime can destroy the trust. Compliance failure include legal penalty plus regulatory action. Bank need ethics, training and monitoring system. And 1988 UN Convention, laundering includes hiding asset from drug crime or any criminal act. Now friends, let's talk about the next slide, that is focusing on the hiding the sea. At its core, money laundering is all about hiding the truth. It focuses on covering up the real nature, source, location, movement, ownership of asset. In other words, making sure that no one can figure out where the money actually came from. This applies to any property, any money gained from the crime, whether it is from theft, fraud, drug trafficking, or even helping someone commit the crime. So by disguising these assets, offender can avoid facing legal consequence for their action. The 1988 UN Nation Convention give a detailed definition. It includes converting, transferring, acquiring, possessing or using crime-derived asset while hiding where they came from. Across the world, this is recognized as the act of making illegal wealth look legal, a way for criminals to shield themselves from the authority. So to just summarize, I told you that money laundering is hiding the real source, location, movement, ownership of the asset. It applies to property from any crime. It helps offender avoid any legal action. 1988 UN Convention says converting or using crime asset while hiding the origin. Globally, it is seen as making illegal money appear legal. Now friends, let's move to the next slide. So friends, FATF, that is the called Financial Action Task Force. It defines money laundering as the process of hiding criminal profit so that no one can trace them back to their illegal source. Criminals do this to keep the money for themselves or for their group without getting caught. Interpol has a similar view. It's about disguising illegally obtained money so it looks completely legitimate, making it hard to link back to the crime. Now, most of the time, the process hides the proceeds of serious crime like drug trafficking or tax evasion, giving criminals the freedom to use their dirty money without restriction. A shocking real-world example of this is the Bank of Credit and Commerce International, or BCCI. Back in 1970, it operated in over 70 countries and became one of the largest private bank in the world. But behind the scene, BCCI was deeply involved in the illegal activity, laundering money for fraudster, arms dealer, terrorist, and organized crime group. Their operations were extremely complex and multi-layered, making it almost impossible for authorities to detect what was going on. This case showed how dangerous money laundering can be for the banking system and why banks need a strong preventive measure to ensure that they don't become part of the criminal network. So we are talking the example of BCCI, right? So let's quickly revise. I told you about FATF, which is hiding criminal profit to conceal illegal origin. Then Interpol, making illegal money look as legitimate. Yes. So commonly hidden hides crime like drug trafficking and tax evasion. BCCI case, huge global bank laundering money for criminals, complex operation made detection hard, highlighted need for a strong anti-money laundering system in the bank. Friends, if you are looking for PDF format revision for these kinds of content, you can WhatsApp me on this particular number shown on the screen. Along with that, we will provide you unit-wise theory PDF, unit-wise MCQs PDF, previous year question, memory-based question that will help you to secure good marks in your upcoming AML KYC examination. Now friends, let's move to the next slide. So basically in 1991 what happened, the authority finally stepped in and seized the Bank of Credit and Commerce International asset worth over $12 billion after uncovering massive fraud. This case showed why bank must run a strict check on their correspondent bank, investigate major shareholder. Banks should have a strong asset forfeiture law to recover criminal proceeds. Then comes the European Union Bank, set up in Antigua in 1994. It promoted itself as the world's first internet-based bank. But behind the flashy marketing, it was openly serving as a safe place for tax evasion and laundering dirty money. By 1995, EUB launched online service that offer anonymous numbered or coded account, making it nearly impossible to track who owned the money. This secrecy was perfect for criminal. The bank collapsed in 1997 when officially disappeared with customer deposit, a textbook example of the risk of offshore banking and the difficulty of enforcing regulation across border. Another infamous case was the Rix Bank. It helped Chilean dictator Augusto Pinochet hide money stolen from child by concealing the account. Eventually, the bank has to pay $9 billion in compensation to the victims. So we have just highlighted few cases like 1991 BCCI seized $12 billion fraud. Then 1994 European Union Bank in Antigua, haven for tax evasion and laundering. 1995 offered anonymous coded account. 1997 collapsed this European Union Bank or EUB collapsed. Official stole deposit. Offshore banking risk was there. Then we talk about Rix Bank, which helped Pinochet hide million. They paid $9 million to the victims. Now what happened to the Rix Bank? In 2004, Rix Bank found itself in serious trouble when investigators discovered that it was moving fund linked to the Equatorial Guinea President Mabasco. Now the bank allowed huge unreported cash withdrawal from the country embassy account, giving Mabasco and his official the chance to siphon more than $35 million. By February 2005, Rix pleaded guilty to breaking the US Bank Secrecy Act and has to pay $16 million fine. This case became another major example of how weak control can allow high-profile money laundering to thrive. Fast forward to August 2013, in India, RBI received complaint about check and demand draft fraud involving 5 major banks. Right? Criminal has opened fake account. Right? Criminal has opened fake account in the name of a statutory body and used them to encash instrument, exposing massive KYC failure. That is called know your customer failure. Around the same time, postal order fraud with similar KYC lapse came to light, leading to penalty of 50 lakh on one bank and 25 lakh on another. So what we have just talked now, we have talked about 2004 infamous case of Rix Bank linked to 35 million siphoned by the Equatorial Guinea president. It allowed large unreported embassy account withdrawal. In the year 2005, guilty under US Bank Secrecy Act, $16 million fine was imposed. 2013 India, check DD fraud in 5 major banks, fake account, KYC lapses were there, and postal order fraud was there, because of which penalty of 50 lakh was imposed and 25 lakh. Now let's see the one more case. In 2014, a review of bank branch in Mumbai exposed a worrying scam, fraudulent overdraft against fixed deposit. This was not just a small banking error. It revealed serious KYC weakness and potential risk of money laundering. When the RBI expanded its check to the public sector bank, the picture got even worse. In the 12 different branches, they found clear KYC violation. Customers were not properly verified, transactions were not monitored closely, and due diligence was quite weak. The punishment was serious, 1.5 crore penalty each on 3 banks and formal warning to 8 others. By October 2015, Enforcement Directorate and the Central Bureau of Investigation were investigating suspected trade-based money laundering, which led to multiple assets. So we have just now talked 2014 fraudulent overdraft against FD in Mumbai KYC caused KYC failure. RBI found KYC violation in 12 branches, poor verification, weak monitoring. 1.5 crore penalty was imposed each on 3 banks, 8 got formal warning. In 2015, ED and CBI probed trade-based money laundering and arrests were made. So friends, let's quickly revise the point which we have just covered. I told you in 2014, fraudulent overdraft against FD in Mumbai, it shows KYC failure. Then RBI found KYC violation in 12 branches, which indicate poor verification and weak monitoring. 1.5 crore penalty each on 3 banks and 8 got formal warning. And in October 2015, ED and CBI probed trade-based money laundering and arrests were made. Now friends, trade-based money laundering is one of the most dangerous form of financial crime because it hides dirty money inside what look like normal trade transaction. Between July 14 and July 2015, July 2014 and July 2015, right, what happened? Excuse was the import, but the reality was that the import did not exist. The money was routed through cell company and multiple bank, about 6.5% came as cash deposit, while the rest moved through the banking channel. In October 2015, Enforcement Directorate went after another case. An individual was laundering money through fake foreign exchange transaction. 8 bank processed payment for import that never happened. And it is not just history. Between 2006 and 2010, one person used 70 fake accounts in 7 banks to move 500 crore abroad. Again, they claimed that it was for import, but instead the money was secretly diverted internationally. The scheme ran on a mix of cash deposit and 66 bogus accounts. Now, let's talk about the regulators. So, when it comes to money laundering and terrorist financing, regulators around the world, from the US to the UK, don't play nice. Right, they strictly enforce AML CFT rule, that is anti-money laundering and countering the financing of terrorism against the bank and individual employee. Suppose if the compliance is weak, the consequences are huge: heavy fines, legal action, official warning that can cripple a business. And it is not just about money. A damaged reputation can destroy a bank future, scare away foreign investor, and shrink the business opportunity. And what is the root of many cases? The root of many cases: poor customer verification, weak transaction monitoring. These gaps make it easy for criminal to launder money or to commit fraud, which can lead to serious financial loss. And here is the part that many don't realize, that employees themselves are not safe. They can face personal fines, regulatory bans, even jail time, plus a permanent stain on their professional reputation. So what we have talked in this slide, I told you that global regulator strictly enforce AML CFT rule on bank and staff. Weak compliance will cause fine, lawsuit, and official warning. Bad KYC and monitoring. What will happen? That money laundering and fraud risk will be there. Reputation loss will cause less burden and foreign investment. And employee risk, personal penalty, ban, and prison. Now friends, let's talk about the terrorism financing. Friends, if we talk about the terrorism financing, it's all about raising or moving money to support terrorist act and the terrorist group. And here is the tricky part. The money can come from illegal activities like smuggling or drug trafficking, but it can also come from perfectly legal source like donation or business profit. The real goal is to hide where the money come from and where it is going to be used for. Now, a terrorist attack might only need a small amount of money, sometimes less than the cost of a car, but running a terrorist organization, it basically long term take big ongoing funding for training, travel, propaganda, and weapons. The 1999 US Convention defined terrorism financing as knowingly collecting or providing money for acts that can cause death or serious injury to civilian, with the aim of intimidating people or pressurizing the government, even if that money is never actually used in the attack. Different countries have different definition because the term terrorism itself can be politically and legally sensitive. And here is the key difference to remember, that money laundering it means making illegal money look legal, and terrorism financing, it means funding violent act using legal or illegal money. The source does not matter, it's about the intent. Right, so money laundering means making illegal money looks legal, and terrorism financing means funding violent act using legal or illegal money. The source does not matter, but it's all about the intent. So let's quickly revise whatever the topic which we have discussed. I told you about terrorism financing. It means raising or moving fund for terror act or groups. Money can be legal, money can be illegal in origin. Goal is to hide the source and the purpose of the fund. UN in the year 1999 providing money for act causing death, injury to civilian, for intimidation or coercion. So they define terrorism financing as this. So key difference is that laundering cleans dirty money, terrorism financing fund violent act. That's the difference between money laundering and terrorism financing. Now money laundering is not just one trick. It is a flexible and ever changing process. How it is done depends on things like where the money come from, how much there is, where it is going, and who is moving it. Criminal can get very creative, designing a scheme so clever that even experts struggle to detect them. And sometimes bank or financial institution get caught up in the process without even realizing it. A lot of dirty money start off as a cash from crime like drug trafficking, extortion, or contract killing. The process usually happens in three stages. First stage is called placement, which means putting dirty cash into the financial system. Second is called layering, which means moving it around through complicated transaction to hide where it came from. Third is called integration, which means bringing the now clean looking money back into the economy through legitimate account, investment, or big purchases. At the end of the day, the goal is simple: to turn illegal money into money that looks legal, so that it can move freely without raising suspicion. So three stages I told you: placement stage, layering stage, integration stage. Placement means putting dirty cash into the financial system. Layering means moving it through complicated transaction. And integration, it means bringing the now clean looking money back into the economy through legitimate account. So at the end of the day, the goal is simple: to turn illegal money into money that looks legal, so that it can move freely without raising suspicion. So let's have a quick revision of the point which we have covered in this slide. So money laundering is flexible depending on the source, amount, and people involved. Criminal use creative scheme which is hard to detect, right? Often start as cash from serious crime. There are three stages. The first stage is called placement. Second stage is called layering. Third stage is called integration. Right, goal is to make dirty money looks clean. Now friends, let's talk more about the placement. So what happened, this is where criminals sneak dirty money into the official financial system. It might be through cash deposit, cross-border smuggling, or breaking large amount into a small transaction so that they don't trigger reporting rules. They use multiple bank accounts and keep changing their method to stay one step ahead of the authority. Second step we have is the layering. Layering, what happened? Here is where the things get tricky. Criminals move money around, sometimes across different accounts, different countries, even fake business deal to hide where it came from. So the criminal might use rapid electronic transfer, high transaction volume to make their activity blend in with the normal banking traffic. The goal is to make the money trail as confusing as possible. Third step is integration. Finally, the cleaned money make it grand entrance back into the legal economy. This could be through investment in a stock, real estate, commodities, other asset. By this point, it looks legitimate and is almost impossible to link back to the original crime. So for banker, placement is easy to detect because it involves direct cash deposit, right? Layering require watching for unusual transaction pattern, and integration need deep customer profiling to catch suspicious origin. So let's quickly revise. I told you, placement means getting dirty cash into the system. A small deposit, multiple account, this can be the sources. Layering means moving it around to hide its origin, like complex transfer, fake deal. So placement is easy to detect because it involves direct cash deposit. Layering require watching for unusual transaction pattern. And integration means spend or invest it like a clean money. So for that you need deep customer profiling. Banker, cash handling, easy warning. For banker, cash handling is the early warning, pattern is the mid stage clue, and profiling is the last line of defense. So friends, one of the biggest headache for bank is figuring out whether money is clean or connected to something illegal, especially when it comes to terrorism financing. Here is the tricky part. Funding terrorism does not always involve huge sum of money. Sometimes just a small amount is enough to carry out an attack. But keeping a terrorist organization running, like training member, buying weapon, so basically expanding network, they need much bigger budget. Right, so basically individual attack might be funded with modest amount disguised as personal remittance. The money can come from cash or regular bank account. Sometimes the people sending or receiving the money don't even know that it is for terrorism. They just get a small commission to pass it along. Because the amount are small, it is very hard for the bank to spot. Now let's look at the Funding Terrorist Act. So what happened? State sponsored. They are backed by certain government, often posing as social or charitable organization. Second is a legitimate channel. So money from business, individual, or charities given for declared purpose. Then we have the criminal sources. So fund from illegal activities like drug trade, kidnapping, bank robberies, or extortion. So let's quickly revise. So I told you that terrorism funding can be a small for single attack, but large for running organization. Money is often moving through legitimate looking front like charities or welfare group. Funding come from government, legal donation, or criminal activity. A small amount and hidden source make detection extremely tough. Now let's talk about, so this point we have just talked now. Now let's talk about the risk. Yes, So basically, what is the key learning for the banker? I told you. Let's have a look. So for banker, here is the challenge. Sometimes a terrorist attack is funded by a small remittance that look harmless. This requires a special monitoring tool to detect. Right. The problem is that there is often very little intelligence about how terrorists move their money, which make constant vigilance essential. Bank can help by closely monitoring high risk area, customer type, unusual transaction pattern. This kind of data can be passed to security agency to stop attack before they happen. A strong due diligence, basically double checking, right, who your customer are, where their money comes from, help avoid serving terrorist linked entities by the accident. And don't forget the reputation risk. If a bank is even suspected of helping terrorism, it can lose public trust instantly. So where does this illicit money come from? So first is the drug trade. That means huge profit from illegal narcotics. Second is the organized crime like extortion, prostitution, loan sharking, kidnapping. Then we have corporate slush fund used for bribery or shady political payment, global armed trafficking, human trafficking, smuggling of goods or people across the borders, tax evasion on legal income, often using the same trick as money laundering. On tax evasion, all countries don't all agree. Some see it as money laundering and others don't. But the trend is clear. It is getting more attention from the regulators worldwide. So what we have just discussed, let me summarize. That terrorism financing often rely on big criminal profit. A small, suspicious remittance can hide funding for attack. Bank need a strong monitoring, due diligence and intelligence sharing. Major sources include drug, organized crime, trafficking, smuggling, tax evasion. Reputation damage can be as bad as legal penalty. Now friends, let's talk about joint money laundering. So in London, there is a group called Joint Money Laundering Steering Group. Their job is to spot the most common trick criminal use to hide the dirty money. So one major trick is that they use the same banking service as you and me, but in way that make illegal money look legal. Technique is that deposit restructuring or smurfing. Imagine you have got a big bag of illegal cash. You don't just dump it in one account that is suspicious. Instead, you split into a lot of smaller deposit, each just below the limit that forces the bank to report it. Right. Then you might use multiple accounts. You might get different people to make the deposit. You might move the money between bank in different cities. Then quickly withdraw it in cash before anyone notices. Then second technique used here is the multiple account tiers. This is like passing the money through several filters. Each time it is split into a smaller amount and moved again, often in triangular pattern that make it almost impossible to trace back to the original crime. Technique 3 is the funnel account. Here, a small deposit come in from many people into one account, always under the reporting limit. Then, bam, the money is withdrawn instantly from a complete different location, so there is no clear link between where it came from, where it went. So what we have discussed just now, that criminal use normal banking service in sneaky way. Smurfing means breaking big money into a small deposit under the reporting limit. Multiple account tiers, it means pass money through layers of account to hide its origin. Funnel account means a small deposit in one place, quick withdrawal somewhere else. Right, that is called funneling the account. Now friends, let's talk about more sneaky trick criminal use to clean dirty money. These are like greatest hit of the money laundering method bank need to watch out for. The first is called contra transaction. This is when huge amount of money keep moving back and forth between the same account over and over for days, for even months. There is no real business reason. It is just to create confusing activity so that no one spot the real source. Then we have the bank draft and similar instrument. Criminals sometimes buy draft, money order, cashier check using cash. So friends, criminal what they do, sometimes they buy draft, they buy money order or they buy cashier check using cash. These instruments are drawn from well-known bank, so they look legitimate. But the goal is to wipe away the cash trail, making it harder for investigator to trick. Then we have the cash deposit and transfer. Drug trafficker and other criminal might dump huge cash deposit into bank and then quickly transfer the money overseas. They pretend it is a part of the normal trade to avoid suspicion. They even send it to country with no link to the crime, just to throw the authority off. Then we have the connected account. Here accounts are opened in the name of relative, friend, fake owner. They are also called Benami account. Right? Sometimes lawyer or professional help set these up so that the real owner stay hidden. Then we have the shell company. So these are fake or paper only business, often registered in offshore tax haven. So money is moved through multiple cell company to make ownership impossible to trace and create a maze of transaction. So let's quickly summarize the point which we have covered. We started with the contra transaction. I told you this is kind of money bouncing between account for no reason. Then we talk about bank draft. So it is bought with cash to erase the trail. Then we talked about cash transfer. What happened? Big cash deposit quickly sent abroad under the fake trade deal. We talked about the connected account. So it is opened under. So what is a connected account? It is opened under another people's name to hide the owner. Then we talk about sale company, which is a fake business used to disguise the money flow. Now friends, then we have front company. So these are real business that look legitimate like bank, casinos, brokerage firm, but secretly miss illegal money with actual sale revenue. Right? Think of it like pouring dirty water into a clean jug so that no one notices the dirt. So why use existing company? Opening a fake name bank account is tough nowadays. So criminals prefer buying and partnering with established firm to use them as disguise. Multiple personal account. Some people open different bank account for different purpose. One for salary, one for business, other just to move illegal fund. Then we have money mules. What is the meaning of money mules? So this is when third party allow their account to be used for transferring money. They might not even know the full history or full story. Sometimes they just get paid a small commission for helping out. Then we have the dormant account. So they are the old or rarely used account that suddenly come live again. Criminals use them to look like regular customer, receive overseas transfer and quietly move the fund. A strategic fund transfer. Instead of sending large amount, they move a small sum over the time from this account to finance illegal or terrorist activity, staying under the radar of monitoring system. So let's quickly revise the point which we have covered just now. We started with the front company. I told you these are the real business hiding the illegal cash. Then we talk about the existing firm. They are easier than fake name account. Multiple account, each with a different purpose. Money mules are other people account for anonymous transfer. Dormant account are the old account reactivated for laundering, and a small gradual transfer is done to avoid triggering detection alert. Now friends, let's talk about the wire transfer. So what is wire transfer? Some intellectual money trick that criminal use to move illegal fund across border. Wire transfer is one of them. These are quick electronic transfer through bank or money transfer company, sometimes even from a small retail shop. While legal, they can also be used to send. While wire transfer is legal, but they can also be used to send dirty money far away in second. Then we have the collection account. How it works, a group of people like immigrant sending money home, they pull a small amount into a single account and send it abroad in one go. Totally legal, but criminal can sneak in unrelated illegal deposit to hide in the mix. Then we have payable through account. So these are the local bank account owned by foreign bank or company. People overseas can use them like sub account to send or receive money. The problem is that it is hard to know exactly who is behind each transaction, making KYC check tricky. Then we have back-to-back loan. Imagine you have dirty money in one country. You use it as a security for bank loan in another country. Then you bring that loan money back home and voila, it look clean and legal. Then we have trade finance manipulation. Here criminals fake the value of good, either overpricing it or underpricing them, so that they can secretly send or receive money under the cover of normal trade. On paper, it looked like a business deal. In reality, it is a money transfer. So let's quickly revise the point which we have just covered. So we started with the wire transfer. I told you this is the fast borderless money movement. Collection account, they are the pool deposit, open to abuse. Payable through account, these are the local account for foreign user, hard to trace. Back-to-back loan, they use dirty money as collateral to get clean loan. And then we talk about the trade finance trick, which means fake invoice value to move money as trade. Then we talk about the trade or invoice manipulation. Basically this is when criminal pay way too much for cheap or useless good. The good gets shipped abroad, but the real goal is to send money out of the country. Sometimes they just throw the good away or sell them for peanuts. The shipment is just a cover. Now we have something called buying high value asset. Think luxury car, private jet, expensive art. Criminal buy these using illicit cash and then export them to another country once they are abroad. So it is harder to trace who really owned them or where the money came from. Then we have the agent and alternative remittance system. Instead of sending money directly, criminals settle account across country through trade deal or goods exchange. This way there is no obvious money transfer for authorities to flag. Then we have offshore bank. These are the bank in country known for weak regulation and high secrecy, like the Bahamas, Switzerland, Singapore. They can quietly accept suspicious deposit, often disguised as business transaction. Then we have the cell company. We have already discussed it. So these are the companies that exist only in paper, no real business, no staff. They are using to make fake invoice, create fake business deal, get loan backed by the hidden asset. Cell bank. This question was asked. Just like cell company, these pretend to be bank but don't actually do real banking. They usually set up offshore. They hide behind secrecy law, making it almost impossible to find out who is benefiting from the money. So cell company and bank are super versatile. They can be used at one stage. So friends, trade trick basically is to overpay for worthless good to send money abroad. High value asset means buying and exporting luxury item to hide the origin. Alternative remittance means settling payment through trade instead of cash. Offshore bank, they hide money in secrecy friendly country. Sell company means paper only firm for fake deal. Sell bank means fake bank shielding the real owner. Right, these are the points which we have just cleared. Now friends, let's talk about how criminal turn everyday payment tool into money laundering machine, like credit and debit card. So launderer pay off card balance using cash, but they split payment into a smaller amount so that bank don't have to report them. They also use cash advance from card to quietly move fund without drawing much attention. Then we have the prepaid card. They are even more dangerous because they can be anonymous. Forex version are especially risky. You can load them up and use them worldwide without needing a bank account. That is why they are a favorite in the terrorist financing. Then we have the border cash movement. Criminal move physical cash near international border, slipping it across with minimum scrutiny, sometime through country, sometime hidden in vehicle or goods. Then we have Burex D charge. Currency exchange counters. Here, a small note can be swapped for larger one or local currency converted into foreign cash. They can also exchange traveler check or money order, making the fund harder to trace. Then we have the regulatory gap. In country with weak rule for money changers, it becomes very easy for criminal to hide their activity. So let's quickly summarize the point. I told you credit and debit card, a small cash payment plus credit advance to avoid detection. Prepaid card, anonymous global use, big terrorist risk. Border cash, sneaking money across country physically. Currency exchange, what we do, we swap cash type to confuse the trial. Then weak regulation, so poor oversight make laundering easier. Then let's look at the remittance services. There are services basically that transfer money from one country to another, usually into someone bank account. Sometimes the recipient in the other country sells their local currency to foreign buyer for legitimate purchase, but the original money might not be so legitimate. Now this is popular with diaspora community. So what it means, diaspora community, that many migrant community use these remittance services to send money home because the fee are lower than regular bank and the system has been around for decades. Now alternative remittance system, you know what it means. This is an informal cousin of banking. Instead of going through the official channel, it use broker or even a small neighborhood shop that are connected across the country. So how it works, let's say someone in the country A give cash to a broker. That broker contact another broker in the country B. The broker B hand over the equivalent amount to the recipient, often without sharing full customer detail. The commission get deducted and sometimes they only use a quick phone call or fax to confirm. So this is called informal banking system or alternative remittance system. Then we have the lighter regulation. Because these services are not bank, they often don't have to follow a strict compliance rule, which make them attractive for those who want anonymity. Then we have the terrorist financial risk. Small, frequent transactions with minimum record are perfect for terrorists who want to keep funding flow hidden. So let's quickly summarize the point I told you. Remittance service means sending money across border, cheaper than bank, common in migrant communities. Alternative system uses broker or shop. It is less regulated. Minimum customer information means anonymity is quite easier. High risk for terrorism funding due to a small or discreet transfer. Now friends, let's talk about the execution detail of the informal money transfer system and why they are so attractive for criminal and terrorists. First point is that almost no physical cash movement. In many cases, no actual money crosses the border. Instead, it is all done with informal balance and trust. Minimal record, which means transaction might be confirmed through coded message sent by courier, letter, faxes or even phone call. The goal is to leave behind as little evidence as possible. Then the audit trail problem. Since there are barely any record, investigators have a tough time tracking the flow of money, which is exactly what criminal wants. Then we have the terrorist attraction. This system is discreet, cross-border, hard to trace, perfect for those trying to fund terrorism without drawing the attention. Then we have the Hawala system. Hawala is one of the oldest informal value transfer network. It operates completely outside government control. It is based on pure trust, no contract, no paperwork. How it works, you give money to a Hawala agent in one country and the agent tells their counterpart in another country or city to pay the recipient. It is fast, cheap and anonymous, which is why it is still widely used in the part of South Asia or for everything from migrant remittance to illegal terrorist financing. So let's do the quick revision. I told you in this case there is a minimum cash movement. It uses code for confirmation, little to no paper trail, hard to detect. Hawala means trust-based network outside government or oversight, and widely used for both legal remittance and illegal terrorist funding. Now let's talk about the insurance policy. Let's look at some of the most creative way criminal moves the dirty money. Criminal buy expensive insurance on valuable item, pay large premium through bank, then cancel the policy early. The refund sent straight to an overseas account. This look perfectly legitimate. Internet banking. With so many online banking services often connected to stock trading, launderers love the fact that there is no face-to-face verification. It is fast, remote, anonymous. Then electronic money. So think of card-based EP purses. You load them with cash, spend it online or buy a small asset, and the trial become harder to follow. Then the gold market. You know what it is? Gold is the money launderer dream. High value in a small package, easy to check for purity, and always in demand worldwide. You can move a fortune in just a few bar. The diamond market. Yes, diamond pack even more value into less weight. But the market is tricky. You need the right buyer. And unlike gold, you can't easily split a single stone into a smaller amount for transaction. So what we talked about: insurance, pay premium, cancel early, refund overseas. Internet banking, no face-to-face verification. E-purchase, loaded with cash, buy asset quickly. Gold, high value, portable, always in demand. Diamond, higher value than gold but less flexible. Now let's talk about the gold market. So gold is loved worldwide for its value, easy convertibility, and the fact that you can trade it quietly. But that is exactly why it is favorable for criminal, especially in drug trafficking, corruption, smuggling. If gold comes from theft or illegal import, it needs laundering also. And since gold has a strong cultural and religious demand in many countries, it is easy to mix illegal gold with the legitimate trade. Then we talked about the diamond. Diamond are tiny, portable and extremely valuable per gram. That make them attractive for both criminal and the terrorist group. They can buy diamond directly with crime money, use them in shady forex deal, swap them for casino chips, forgo invoice or blend dirty money into legitimate diamond trading account. Then we have the PEP, politically exposed person. These are the people in the powerful public position like ministry, senior officials, judges. When corrupt, they can use their influence to move large sum quietly, making them high risk for money laundering and terrorist financing. Then we have something called misuse of NPO, non-profit organization and charities. Sadly, even charities can be misused. Terrorists sometimes create fake charity to move the money, or they can infiltrate real humanitarian group without the staff or donor knowing. They can also use NPO, that is non-profit organization, as front to move money, to move fund internationally and support the operation. So let's quickly revise. We talked about gold, which is a valuable, portable, easily mixed with legal trade. We talked about diamond, which has high value per gram. Multiple laundering tricks are there. We talked about PEP, which is a powerful people can misuse position for laundering. NPO, which is fake or infiltrated charities, which is used to move illicit fund. So these are the points which we have just made clear. Now let's talk about the international. There are some international bodies who actively work. So friends, in 1998, the United Nations took a big step forward. Through the political declaration, the UN expanded its anti-money laundering mission. Before, the focus was mainly on drug crime, but now it covers all the serious offences. This was a turning point, making the fight truly global against a wide range of illegal activity. Then in 2000 came the Palermo Convention, another major UN treaty. This one was designed to tackle transactional organized crime, basically big crime network operating across country. It did three important things. This Palermo Convention did three important things. First thing, that it made money laundering itself a criminal offense worldwide. Second thing is that it recognized that serious crimes should all be treated as a starting point or predicate offense for money laundering investigation. Third point, It told country to set up a strong system to detect suspicious activity and to work hand in hand with other nation and international agency. In short, it was all about building a united front so that criminal can't hide behind the border. So we talked about 1998 political declaration in which AML expanded from drug to other serious crime. In the year 2000, Palermo Convention comes into picture, which targeted global organized crime, made money laundering a crime, recognized serious crime as trigger. Right, these are the points. Now friends, let's talk about the IMF, International Monetary Fund. It's not just about loan and economic advice. Since the year 2000, it has been a major player in fight against money laundering and terrorism financing. So it checked the financial system of the country, especially offshore financial center, to where secret banking can happen. Then it has built the FATF standard. It has built Financial Action Task Force standard, which is the global rule book for fighting the dirty money. It gives country expert advice and training on how to detect and stop the illicit money flow. So the IMF also studies what is working around the world and share that know-how so that more nation can build strong defenses. Now a key part of the system is something called Financial Intelligence Unit, or we call it FIU. They are started in the early 1990 to give law enforcement better access to the cultural financial data. FIU act like a central hub. They collect report from bank and businesses about suspicious transaction, then analyze the data to spot the pattern and share with the investigator. So friends, what I have told you just now, that IMF since 2000 check offshore center, use FATF standard, give AML CFT advice, and FIU, or called Financial Intelligence Unit, they are the central hub for suspicious transaction report. Right now friends, FIU are like the detective of the financial world. Their job is to receive, analyze, share important money related information that help stop money laundering and terrorist financing. After the year 2003, what happened? The global watchdog FATF, the Global Watchdog Financial Action Task Force, make their role even clearer in its 40 recommendation, giving FIU a bigger role in the global defense system. How it works: bank and financial company send them suspicious transaction report when they spot unusual activity. That's called STR. FIU dig through this report, look for pattern that might point to illegal money flow. Then they pass this intelligence to the law enforcement and regulator so that action can be taken. Now on the global level, there is something called Egmont Group. This question was asked. Right, on the global level, there is something called Egmont Group, an international network of FIU that share information securely between the country. Since 2012, FATF has made Egmont membership a must-have for an FIU to be considered effective. The Egmont Group also provide training, exchanges experts, keep communication secure, and help FIU stay independent so that they can do their job without interference. So what we talk about FIU, it is the detective of the money world. They collect and analyze suspicious transaction report, or we call it STR, and the Egmont Group is the global FIU network for secure information sharing, training, and cooperation. Now let's talk about the FIU development. So friends, how financial intelligence units are being strengthened worldwide. The focus is on a better cooperation across border so that countries can work together against money laundering and terrorism financing. That means more secure information sharing, regular training program, exchange of expertise between FIU. To keep everything consistent, the global FIU network, which is known as Egmont Group, has published operational guidelines to help standardize how FIU operate. They also have issued the Egmont Charter and the Egmont Principle for Information Exchange. Today, Egmont membership has grown to 151 FIU around the world, showing just how important this network has become in the global fight against the financial crime. Now let's talk about the BCBS. That Basel Committee on Banking Supervision, or BCBS, is basically the top global body that set the rule for keeping banks safe and trustworthy. You can think of it as a meeting place where banking supervisors from around the world share idea and agree on the standard. One of their big focus area is the AML. What is AML? Anti-money laundering, and KYC, which is called Know Your Customer rules, which help bank verify who they are dealing with and spot suspicious transaction. The BCBS says bank must do proper customer check, monitor transaction carefully, and use a risk-based approach so that they can stop criminal from slipping dirty money into the system. So it is so important because if the bank is linked, even by accident, to criminal, it can lose public trust overnight and face massive fraud risk. So what we talk about, BCBS is a global rule setter for safe banking. Main focus is a strong AML and KYC practices. The goal is to stop bank from being used by criminal and to protect the public interest. when it comes to the ethics in the banking, the rules are simple but strict. First of all, bank must know exactly who their client are. No guesswork, no shortcut. Second is they must avoid processing any transaction that look fishy or illegal. Third point is that they must work closely with the law enforcement to stop financial crime. So now where do this rule come from? Back in the year 1996, G7 Lion Summit, the Basel Committee on Banking Supervision created the core principle for effective banking supervision. In 1997, this included 25 principles, and one of the strongest was know your customer, making sure that bank don't get used by the criminals. Fast forward to 2012, this principle grew to 29, and the principle 29 focused directly on preserving the abuse or preventing the abuse of the financial services. And now, then let's talk about how the Basel Committee tightened the rule on know your customer. In October 2001, what happened? In October 2001, the BCBS released their full KYC guide, customer due diligence for bank. This was like a handbook telling bank that how you can check who you are dealing with properly. In January 2014, what happened? This was upgraded to a newer, more detailed guide called Social Management of Risk Related to Money Laundering and Financing of Terrorism. Think of it as a 2.0 version. So back in February 2003, Basel Committee gave bank a general guide that focus on three main things. Customer acceptance, which means have a clear policy about which customer you will accept and you will not work with. Second is the identification and monitoring, which means always verify who your customer is and keep an eye on their account over the time. And finally, risk management, which means have a strong control to catch suspicious activity early. That same month, they also published cross-border KYC standard. Basically, basically telling bank don't lower your guard when the customer is overseas. In short, whether local or international, the rule is simpler. Same, know your customer, and it will really will work. Now friends, let's talk about how the Basel Committee makes sure that bank know exactly who they are dealing with and how money flow across border. First of all, they say information requirement. Basically a checklist of the data bank must collect to properly identify people and company. No guesswork, no half-filled form. Then in May 2009, what happened? They issued new rule to make cross-border payment more transparent, especially something called cover payment. So this is called cover payment, right? That is when money is routed through multiple banks. They said include a specific detail in every payment message. Make sure this information actually travel with the money. Why? Because missing detail make it easier for criminal to hide their track. In January 2014, what happened? They stepped in with sound management of risk related to money laundering and financing of terrorism. This matched the FATF standard, but also give bank extra tip on building a strong risk management system. Right. So now then we have the document consolidation. So what is document consolidation? So the Basel Committee decided to tidy things up by merging two old documents into one clear updated guide. So they say risk check should not be one size fit all. You need to assess risk at 4 levels: the country, the sector, the bank itself, and even a specific business line. So that are the 4 lines: bank, country, a specific business sector, and the sector, right? So for governance, the bank board of directors has to sign off on anti-money laundering policy, but also watch to make sure that they actually work. There is something called three line of defense. Question is asked based on it. The first is the business unit, which is spot and handle risk in day-to-day work. Second is the AML CFT compliance team, which double check and strengthen the control. And third is the internal audit, which act as an independent reviewer to see if everything is effective or not. Finally, bank must have transaction monitoring system that matches their size and the risk level. If the bank operate internationally or bank has a complex risk, they may need advanced automated system to keep track of the suspicious activity. So remember this 3 line of defense. First line of defense is called business unit. Second is called AML CFT compliance team. Third is called the internal auditor. Right. So let's quickly revise. I told you that one updated guide replaces 2 old one. Risk check at country, sector, bank, and business line level activity. 3 line of defense is business unit, compliance team, external audit. Now what is called CAP? That is called customer acceptance policy. So basically before a bank open an account or a process that transaction, they must check who you really are. That is called due diligence. The level of checking depends on your risk profile. If you are considered low risk, it is basically verification. But if you are high risk, that company, say complex ownership structure or linked to risky industry, And it's not just about person standing in the front of the bank. They also check the beneficiary owner behind the scene using trusted independent source. Once you become a customer, the monitoring does not stop. Bank keep an eye on your transaction using the risk-based approach that adjusts if your risk profile change. FATF set the international rule. Right, the famous 40 recommendation for fighting money laundering. It was launched in the year 1990. After the event of 2001, they had 9 special recommendations on the terrorist financing. So these rules keep evolving to fight new threat and to protect the world financial system. So what I told you about CAP is about verifying the identity before transaction. Higher risk with deeper check is required. It includes beneficial owner verification, ongoing monitoring for all customers. FATF was formed in the year 1989. It is Global Anti-Money Laundering Standard Letter. Then there are 40 recommendations which was given in the year 1990 plus 9 recommendations on the terrorist financing in the year 2001, constantly updated to tackle the new kind of risk. Now what happened in the year 2003, that by 2003, global rule to fight money laundering and improve customer check became even tougher. By 2005, FATF introduced cash courier control, basically tool to monitor and control large amount of cash being carried across the border. In 2012, FATF issued a big update, now called the International Standard on Combating Money Laundering, Terrorist Financing and Proliferation. Now there are some recommendations which has been given. We will cover in the next video, module B. So I hope this video was useful for you. We have covered the main points. If you really think that video was useful, please hit that like button. If you want such kind of PDF, please WhatsApp me on the number shown on the screen, or in the description section of the video you can get the course link. Thank you.